We are so excited to be here for the second day, the second gorgeous year in a row at the Tampa River Center for the Florida Farmers Investor Summit. None of this is possible without the people in this room, our investors, our founders, and our partners. And to kick it off, we have a little video, so if you turn your attention to the screen.
Welcome to the 2024 Florida Funders Investor Summit. It's time to find, fund, and build the next generation of tech companies. Let's face it, tech is at the heart of Florida's economy, and it isn't slowing down. With the largest investor network and the most active venture capital fund in the state, we lead tech investing, but not only in Florida. We believe in a lasting partnership with our portfolio companies. We've learned a thing over the past 8 years. Building out 4 funds takes patience and the right team of both investors and founders. We look for great founders that are changing the world and investors focused on building a better tomorrow. Let's get started.
We have a great day put together for everybody in the room here today. We're going to hear from some of our founders on panels, and then we're also going to have a founder expo at the end of the day. We have about 20 of our companies that are going to be here today, and all of our investors can meet those founders and learn more about those companies. We also have our keynote Fireside chat with Cathie from ARC and Tom Wallace, the managing partner of Florida Funders. But before we kick it off, I wanted to thank all of our sponsors. We have our platinum sponsor for the day, Silicon Valley Bank. We have our gold level sponsor, Dual Booth Partners, Cherry Becker, Foley & Lardner, LCG Advisors, Nate Nail, M&A Family Capital Partners of Raymond James, Stoneweg, and Trent Law. Please give it up for these sponsors. It was not easy to Please enjoy the rest of your lunch. We're going to get going with Tom Wallace, the managing partner of Florida Funders, in about 20 minutes. And once again, thank you all for being here.
Welcome. Thank you so much for joining us. Really excited. What a beautiful day. What a beautiful venue. We have a really exciting, what we think is a really exciting program for all of you. I use ChatGPT to do some of my speech. So on full disclosure, it really doesn't talk the way I talk. So it says, ladies and gentlemen, esteemed investors and distinguished guests. That's not something I would normally say. It's with great pleasure and excitement that I welcome you to the second annual, this is our second year, annual Florida Funders Summit. Today we gather here to celebrate innovation, entrepreneurship, and the boundless possibilities that lie within the realm of early stage tech investing. Again, we think we have a really good program for you all today, and hope you'll enjoy it. And excited to hear. We have some industry experts. We have a bunch of our founders. We have 18 of our founders joining us today. We're really excited about that. And there's going to be a setup. There's a setup. 4 to 6 over there with the founders, so they're going to have tables. So you can mingle and talk to them at the happy hour. And then we're extremely excited to have Cathie joining us, who is arguably the most influential tech investor of our time. So she's going to be here a little later, and we're going to do a little fireside chat with her. So it's great to see so many old friends and familiar faces, people that have been here really with Florida Funders and supporting us since day one. People like Steve McDonald and Alex Sink, Lance Rabb, Carl and Lita Lindell, Cheryl Hunter, and I'm sure I'm missing some folks, but great to see you all. I'm glad you could join us. And it's great to see so many new faces and people that are new to Florida Funders. We welcome you and hope you'll join us on our journey. I'd like to start by introducing the Florida Funders team. They're spread out, but as I mentioned them, if you could wave or stand up. First, the old guys in the guard, Mark Blumenthal, the old partners, Mark Blumenthal. Why don't you hold your applause? We'll get through this quick. Kevin Adamak, Mark Sokol, and we have the new guard, the young buck Saxon, Ryan Whitmore, and Michael Cato. Did Michael not get here yet? Michael's not here yet. Okay. The key is me getting through this without forgetting anybody. Then we have Maria Derche, our Vice President of Platform and Communities. You're going to hear from Maria in a little bit. Chelsea Oppenheimer and Zach Brodsky, who are part of our deal team under Ryan. Saxon sidekick, Sam Oleszewski. I butchered it. I knew I was going to do it. Sorry. And now on the finance and compliance side, underneath Michael, we have Kristen Ackle and Ashley. I think Ashley's on the side. So all of us will be here all day. Feel free. Most of us have Florida Funder stuff. I think all of us have Florida Funder stuff on. Feel free to grab us and ask us any questions, and we're here to help you in any way we can. So, when I think about Florida Funders and what we're all about, I think first and foremost that we are raging fans of founders. We love entrepreneurs. These young men and women who are willing to take the risk and put in the years of hard work and sacrifice to pursue their dream and build a great company that may one day change the world. That's what we're all about. We have a passion for entrepreneurship. We think it's what makes this state great. We think it's what makes this country great, and it's what drives innovation. So that is our passion. I'm reminded, I just finished Elon Musk's book, Isaacson's book, and you guys read it, some of you sure have read it. And thinking about entrepreneurs, oh my God, talk about, the absolute quintessential entrepreneurs. Entrepreneurs can be a quirky bunch, as we all know, especially those of us that work with them every day and used to be one. Reading this book about Elon, I was truly blown away, not so much by, all the things he does right, but all the stupid stuff this guy does. I mean, it's just unbelievable times. He himself even says, he says he can't help but stab himself in the eye and then cut off his own foot. I mean, whether it's posting a tweet that, he's going to take the company private and violate all these SEC rules, or, he decides to move this Twitter farm, with 750, 2,500-pound servers with him and his nephews, and they rent U-Hauls, the stuff this guy does, and then he smokes pot on the Joe Rogan show with SpaceX being this drug-free workplace and a big contract with the government. You can't make this stuff up. But, and it's a big but, when it comes to entrepreneurship, he's fearless when it comes to risk, as you probably all know. He's never been driven by money so much as his mission, and he's here to save the planet, save all of us. We're going to be colonized on Mars when everything goes to hell in a handbasket here. Clean energy and storage and all the stuff he's into. But I think the thing that he does, which all entrepreneurs do, is he works. He's not going to be outworked. Nobody's going to outwork this guy. He refuses to accept that just about anything is impossible. And not only that, he's really good at convincing other people that work for him, the team, that the impossible is really possible. So, against all odds, and this guy does it over and over, against all odds. And the Florida Funders, that's what we're about. We're here to help founders to buy into and invest in them and believe in their crazy-ass dreams, to help and support them any way that we can along the way, because, and many of you in this room are entrepreneurs, we know how hard it is to build a great company. We know how hard it is to be a founder and start something from scratch and build it. And again, against all odds. Because the odds are against every one of these founders. But we're here to help increase their odds and hopefully help them be successful. What could be more exciting? What could be more fun? And what could be more rewarding? And thank you for joining us on this journey. I was thinking about Sam Altman, the founder of OpenAI. I saw this, he recently said, there has never been a better time to start a tech company. Think about it. It was not that long ago that to start a software company, you had to go out and buy massive amounts of computers and servers and invest in all this hardware, and you had to have all these people, and it took a lot of capital and a lot of people. Now with cloud technology, with Zoom and all the virtual working technology, with Microsoft's Copilot, I mean, the average programmer is already, maybe 50% more efficient. We're just getting started with that. It really is a great time to start a company. You can grow and start and scale a company with less capital and less people than ever before in the history of technology. Excuse me one second. What an opportunity. What an opportunity at a time to be a founder. Oh my gosh, what a time in history. There's no doubt that there are startups out there today, companies that are starting today that will change the world, that will be the next Google, that will be the next Apple, will be the next Amazon. But it won't take 2 or 3 decades like it took these companies. It won't take that long. And how long will it take before we have the first trillion-dollar company with less than 50 employees? It's not inconceivable. I'm guessing it will happen. Well, Altman is right, and there's never a better time to be a founder. I gotta keep an eye on the time here. There's this little clock down here. If Altman was right, and there's never a better time to be a founder, then I would argue that there's never a better time to be an early-stage tech investor. The capital that these companies will need to raise and how far it will take them presents an opportunity like we've never seen before in technology. With companies being able to scale, just like we were talking about, less money. With less money, without additional needs of rounds and rounds of capital, and the dilution that comes with it. So it's a great time to be an investor as well. As we embark on this journey together, I am reminded of the profound impact that early-stage investors, like yourselves, have on shaping the future of our economy and our society and our country as a whole. Your visionary insights, bold decisions, and unwavering support play a pivotal role in nurturing and accelerating the growth of innovation, innovative startups, and groundbreaking technologies. I believe now more than ever, investing in early-stage tech venture presents these unparalleled opportunities for growth and wealth creation for investors. We've talked about this before, how we're working on this unprecedented time. I brought this up, and I'm sure many of you, and Cathie would pass her own version of this, so you'll probably hear about it later, but we're at an unprecedented time in history in that we don't have one game-changing technology hitting us like the internet, like the cloud, like the PC did back in the 80s, but we have like 5 of these hitting us at one time. We've got artificial intelligence, blockchain, augmented virtual reality, autonomous vehicles, and robotics, all coming on at one time. Her 5 are a little different than ours. She throws genomics in there, but we don't play in that world. So some have referred to this period in time will be looked back on as we look back on the Industrial Revolution. That's how this will be looked upon, this time in history with all this technology converging, and what an opportunity. And the opportunity, the advancements that will happen to revolutionize industries and change some of the most pressing challenges of, out there, whether it be climate change, cure for cancer, combined quantum computing and AI. I think that's where we're going to find the cure for cancer. Whether it be clean energy, sustainability, the major world problems, all can be addressed through technology. So the opportunities and advantages of investing in early stage technology are extremely exciting. By getting in on the ground floor of an innovative startup, investors gain access to potential high growth opportunities that can deliver substantial returns. That's why we all do this. Early stage investing also offers a chance to be part of a journey, to collaborate closely with visionary founders and contribute meaningfully to the development of successful transformative technologies. The current market conditions, if we look out on the macro economy, it's a good time to be an investor there too. One of the things that we see every day is valuations have come down. It's down substantially from 18 months ago, 24 months. So it's a good time to be making investments from that standpoint. And there's no shortage of deal flow. There's no shortage of startups or entrepreneurs or founders that are looking to start companies. So that side still remains very, very robust, very exciting, and here in Florida. So, and that's what we focus on. The opportunities are abundant, but so are the risks in early stage investing, and this is where we think Florida Funders comes in, because what we like to say is we take the heavy lifting out of angel investing and early stage investing for our investors. We do the due diligence. We average over 100 hours of due diligence on every company before we invest in it. We negotiate the terms, the deal, the term sheets, the deals. We drop all the legal documents. We put it up on our portal for our investors to see. We make it really easy, and that's what we see it as our job, and that's something that sets us apart, I think, in what we do. So we're committed to empowering investors like yourselves with the tools, resources, and insights needed to navigate the dynamic landscape of early stage tech investing. Through our platform, you have access to highly curated. We invest in, for every company we invest in, we look at 100 to give you an idea of how selective we are, with high potential and expert guidance from seasoned investors and entrepreneurs, and a supportive community dedicated to driving innovation and growth. So, as we convene today, let us seize the opportunities that lie ahead, embrace the spirit of innovation, and continue to push the boundaries of what is possible. Together, we can shape a future that is brighter and more prosperous and more equitable for all. Once again, I want to extend my warmest welcome to each and every one of you. Thank you for your valuable contributions to Florida Funders and your support. We could never do this without you. And we're so grateful and appreciative for all your support. And with that, here's to a summit filled with inspiration, collaboration, and transformative opportunities. Thank you all so much for being here.
To kick off the day, I'm going to talk a little bit about the current state of Florida Funders, where we're at, and then also the current state of the venture capital market. As I mentioned before, my name is Saxon. I'm a partner here at Florida Funders. If you currently look at where we stand, we've really come a long way since Tom and Mark started the business about 8 years ago. We've eclipsed the 100 portfolio mark, so we're at 103 portfolio companies. We've had 86 total SPVs done through our investor network, and that's a huge part of our business, as Tom mentioned. We have 56 portfolio companies that have had markups, and many more to come. We're just shy of 200 million assets under management, and with our third fund, we will eclipse that number, which we could not be more excited about. If you look at the total portfolio, not all of our investments are based in the state of Florida. We are Florida Funders, we're Florida first, we're Southeast first. We've been the most active investor in Florida and Southeast for the last 7 years, and this is our home. We really feel like we sort of have this unofficial right of first refusal on Florida-based and Southeast-based deals. So about 68% of the portfolio is based in Florida, 8% is based in the Southeast, and then 24% is based around the rest of the country. We've got 4 total funds, and I'm going to talk about our Fund 3 that we're raising here right now. I'll get into that. But our first fund, our Fund 1, was a vintage year 2017. That fund currently has an MOIC, or a multiple on invested capital, of 1.6x. Meaning if you invested $1, it's now worth $1.60. It has a DPI of 0.15, or 15%, meaning that we've returned 15% of the total capital, and a gross IRR of 38.2%. Now these are 10-year funds. So for the first 5 years, we're in the investment period. We're investing in companies, riding this team of finding companies, and we're doing all that work in heavy due diligence. On the back 5 years is what we call the harvesting period, meaning we're looking for returns. And so we're in that back 5 years right now with Fund 1, hence some of the returns that we've had up to this point. We then did a seed fund with the University of South Florida. This was a small fund that we did. And we did this fund to prove out our strategy that we should be investing a little bit earlier. Maybe late pre-seed, early seed, which we didn't do in our first fund. That fund is at 6.24x MOIC and 178.8 gross IRR. There's several companies in that fund that are driving those high returns. The one that I'd like to talk about today is Lula. Lula is an insurtech company based in Miami. It's the fastest growing insurtech company in the country. We invested in the middle of 2020 at a $2.5 million cap on evaluation. And then as of late, they raised $30 million from Peter Thiel and Founders Fund, marking that company up 65 times since our initial investment. Those stories are out there. It's not every company we invest in, and that's not what we're looking for with every company, but we're super excited about Lula, and that's one of those companies driving those high returns on the seed fund. Then we did our Florida Funders Fund 2. This is a vintage year 2017. And vintage year means we made our first investment in that year. This was a $60 million vehicle. We've invested in 51 total companies. $43 million has been invested up to this point, and we're done with net new investments out of that fund. So all the investments that we're making now out of that fund are follow-on investments into companies that we've already invested into. We're sitting at a 1.39x MOIC. We've had 28 companies in that fund with markups, and we have a gross IRR of 43.5%. There's about 5 companies in that fund right now that we think could return the entire fund. Companies like HealthSnap that I'm going to talk about here soon, Roost, Better, Passes, Flex, all of those companies could return the entire fund just with that one investment. As of late, we've had some really great success of large tier 1 growth funds coming in and marking up our companies. The most recent one, just as of last week, was HealthSnap. HealthSnap raised a $25 million Series B led by Sands Capital. Sands Capital is a tier 1 growth fund that has taken several companies public, such as DocuSign. HealthSnap is the second largest investment in our second fund, and we really just believe it's the beginning for HealthSnap and Samson Baggett and his team. Second, we have Roost, and I saw Aaron Chernin, the CEO of Roost, here earlier. He's going to be here later, right in the back. Thank you, Aaron. Roost just raised a $25 million Series B, led by Meritech Capital, a tier 1 growth fund that preempted the Series B. They reached out to Aaron. Aaron didn't reach out to them. And we could not be more excited about Roost and this company. Just within the first 2 years of our investment, they've already raised 2 price rounds. We currently have an MOIC of 2.87 and an IRR of 86.51. And then Flex closed a $10 million Series A2 led by insiders. Flex is a fintech super app led by Zaid Rahman, a Teal Fellow, and one of the best founders that we have ever worked with. As of late, with this round, the MOIC for Flex is 1.75x with an IRR of 66.3, and they achieved about $8 million of ARR in their first year of business. So these 3 are great examples of companies that we invested in early, and we have big tier 1 growth funds come in and continue to invest in these businesses. That brings me to our new fund, Florida Funders Fund 3. Mark and I have been out raising this fund for the last 6 months. We're sitting at about $28 million in commitments right now. We're targeting $75 to $100 million with that fund. We have a similar strategy that we've had before. We're focused on pre-seed through Series A companies in Florida and beyond, primarily in B2B enterprise technology. And we believe not just what Tom said, that it's a great time to invest, and I'll talk about the current market after this, but we believe we are uniquely positioned because of our team and what we do to achieve great returns with this fund. First off, we have unparalleled deal flow in Florida and the Southeast. We've taken 8 or so years building the brand and building the machine of Florida Funders that we have right now. And we really have these unofficial right of first refusal on Florida deals first. So we believe that having unparalleled deal flow is something that sets us apart. Second, we have a targeted focus and a disciplined process. We focus on early stage B2B software companies. We have a disciplined process. In 2020, in 2021, we weren't chasing those high valuations, the $100 million high-flying pre-money companies. We stuck with what we know, and Ryan and his team do a great job of ensuring that we're investing in the best companies at the right valuations. We have an experienced team. Team means everything in business. I know you entrepreneurs out there know this. We've been investing together for about 7 years. We know how to work together, and we really feel like we have the team to take us to the promised land. We get our hands dirty. The majority of us come from running technology companies, and as Tom said, there is nothing harder than building an early stage technology company. So we get our hands dirty. We take board seats. We have a platform team that's run by Maria Dirci-Russo, who's going to be up here next. And we're available 24/7 to our founders. You can ask any of them that are here today. We really put our founders first, and that's something that we pride ourselves on. Finally, we have the track record to prove it. As I mentioned before, with the returns that we have a strategy that works, we know it works, and we're excited to continue to implement that strategy in Florida Funders Fund 3. We've invested in 3 companies thus far in Florida Funders Fund 3. The first investment was a $1 million investment into Valley Cyber. Valley Cyber is a cybersecurity company based out of Arlington, Virginia. The team has had several exits collectively before, 3 exits total. And then also, they have put themselves in a great position by already reaching $1 million in annual revenue when we invested. This deal was brought to us by one of our co-investors in Pittsburgh, the 412 Fund. So just showing that network that we have of earlier stage investors bringing us those opportunities. And we're really excited about Valley Cyber and what they're building for cybersecurity. The second investment we made was Manifest. Manifest is a little bit of an earlier stage company than Valley Cyber, called a late pre-seed company. We invested $500,000 in this company from Florida Funders Fund 3. This company and Amy Wu, the CEO, came highly recommended from Joey Levy, the founder of Better, and Zaid Rahman, the founder of Flex. When we first were introduced to Amy, we were blown away about her background as a Stanford CS grad, having 2 exits before in the early stage space and technology. She built this product herself. She's going to be here today. And what Manifest does is they're tackling behavioral, operational, and mental health in Gen Z and Gen Y by leveraging AI and content. And we believe Amy is onto something really big. Finally, we invested in Richley. And Richley was the winner of Venture Atlanta this past year. And every year, we give a check to the winner of Venture Atlanta. This is an esteemed honor to win Venture Atlanta early stage. And Richley is a platform that focuses on empowering self-esteem in children. And Margot is here today. She'll be at the expo to talk a little bit more about Richley and what they're up to. These 3 companies you're retroactively invested into by investing into Florida Funders Fund 3. We have a thick pipeline of companies for this fund, and we're raising this fund up until the end of December of this year. Let's talk a little bit about the current state of venture capital. Tom mentioned there's never a better time than right now to invest in venture capital. That's based on these 5 game-breaking technologies, and there's probably more than 5, because if you add Cathie's and you add ours, you're probably close to 7 or 8. But there's something else that's happening here. Really, about midway through 2020, we saw the downturn of the venture capital market. It was really based on public stocks and the NASDAQ taking a pretty big hit, and the valuations that were in the public markets no longer matched up with the private markets. Inherently, what happened was there was a disconnect between the valuations that companies were looking for and that venture capital firms were willing to pay. Well, fast forward now to early 2024, and that is no longer the case. We're seeing great deals and great valuations, and we've never been more excited to continue to invest in early stage technology. Not to mention Florida and the Southeast being the fastest growing technology ecosystem in the country. All of these together put us in a great position for Florida Funders Fund 3. And if you look back at the best returns over the past few decades in venture capital, they all came out of the downturn of 08, 09. Investing in a down market with suppressed valuations and still having great deal flow is a recipe for success. And that's why we believe this fund is going to yield great results. Before I get to Maria, I want to mention one thing. We have our funds, and that's our core vehicle, but as Tom said earlier, we have our investor network, and we have our VIP portfolio stock program. If the fund isn't right for you, maybe you want to pick and choose your own deals, maybe the minimum's too high, any investor can get involved with us for as little as $5,000 on the network. Sam Olashansky right here runs that network, so if you have any questions about the network or the VIP program, please see Sam today. If you have any questions about the fund, please find myself, or Mark Blumenthal, or Tom Wallace. We'd love to talk to you about that today.
Good afternoon, everyone. I feel very short. My name is Maria, as was mentioned, and I'm the VP of Platform and Community. What does that mean? It essentially means once we make an investment, I work really closely with the founding team to figure out how can Florida funders continue to add value and help the company scale to protect all of your investments. And we're often asked by folks like you in the room, how can I get involved beyond just cutting a check? And so today I'm going to talk a little bit about that. But it starts with first understanding what do our founders need? So every year, at the end of the year, we put out an annual founder survey, and we ask our founders, what is it that you're currently struggling with? What could you use help with? And this year, we really focused in on one main question, and that question was, if we could help you with one thing in 2024, what would that one thing be? And we deliberately left this question open-ended. We didn't want to assume we knew what they needed, and we didn't want to constrain their responses. And the results were surprising in some ways and unsurprising in other ways. 83% of our founders wanted the same thing. What was that same thing? Introductions. So those introductions vary. Some of them were introductions to potential customers. Others were introductions to follow-on investors. In some cases, they wanted introductions to subject matter experts or talent referrals. So what you'll find on your sheets inside the booklet are this two pieces of paper labeled Founder Asks. And that outlines, so 14 of the 18 companies that are here today filled out this Founder Ask sheet, and they're telling you specifically what they could really use help with. So I highly encourage you to take a look and identify any ways that any connections that you can make. And during the expo portion of today, which is between 4 and 6 p.m., please make sure you go up to the founders, get to know them, and offer up help. Now, if you're, I know some of them are joining us a little later, but if you're one of our portfolio companies, please raise your hand. All right. So we're very excited that we have 18 of them joining us today. So please make sure you go up and meet them. Another way we want to better leverage you all, and we've been trying to constantly look for both scalable and impactful ways that you can help. And so last year we launched what we call our expert network. Some of you are already a part of this, but for those of you who aren't, I'll give you a little bit of information. It's very simple to join. You fill out a form, and we'll be sending the form out after this event. And you tell us a little bit about your background and your areas of expertise. We then share this database with our founders. We do not share any contact information. When we share this database with the founders, they're able to filter down based on their specific challenge, the industries that they're looking to tackle, and then they can request intros to you all. I'm facilitating all intros. They're made on a double opt-in basis. But we think it's a very powerful tool to put in the hands of our founders to really identify who could be helpful to them. Another way that this is used is actually with our deal team. When they're looking at a deal and they're trying to find a subject matter expert, they're able to sort through this and identify folks that they should bring in on the due diligence side to kind of give some feedback. So that's another way they may be reaching out to you. And so founders, I also would highly recommend you continue to keep this database top of mind. It is full of people who have outwardly said, I want to be helpful. So please make sure you're leveraging that. And Mary Pepino, I don't think she's in the room yet, but she's a perfect example. One of our founders recently used the database, asked to be connected to her, and they had an incredible conversation. She's been very helpful to them. So just a great example of how powerful this tool could be. And lastly, you all are I consider you all as an extension of me and my team. You all are part of the secret sauce. You're incredibly successful, have had, deep careers with incredible expertise. And so the more ways I can leverage you all to help our founders is what my goal is. But we're only as powerful as our network, and we want to keep growing that network. And so there's something that was launched a few years ago. I think we haven't been as vocal about it in recent years, so I just wanted to keep it top of mind, and that's our investor referral program. So that program, if you refer an investor, gives you discounted carry on deals on the investor network, depending on the type of investor that you refer. So we're going to also send out information on this after the event, but really encourage you to, we are huge believers that successful people surround themselves with other successful people, so please make sure you're telling other friends about this, people who could be a good fit, who could both invest but also add incredible strategic value to our founders. So that's it for me. Thank you so much, and I'm going to welcome Saxon back up to the stage.
How's everybody doing today? You guys like the weather? I'm very pleased to be able to do this panel today, and we've got two rock star founders building amazing companies here that are really scaling, and then one of my mentors in my life, Tim Grider. I think he's one of the best investment bankers in the country, so I'm pleased to have kind of this panel. And so I'll back up. I'm Ryan Whittemore. I'm the Chief Investment Officer and one of the partners here at Florida Funders. I've been here 5 years, and my job is really to oversee all of the portfolios, 5 of the portfolios that Saxon talked about, oversee that and all the deal process and then some of the legal aspects, along with Cheryl Hunter, our outside counsel. But today, and this is what all of the LPs in the room certainly want to hear about exits, and all the founders in the room want to understand about scaling. That's what we wanted to talk about today. Really cover kind of what's happening out there in the market and how are companies approaching raising rounds and growing. There's been a lot of talk over the last 2 or 3 years about, for years and years and years, Silicon Valley kind of pushed the idea of growth at all costs. And then as the capital markets got a little bit tougher, there's been a philosophy of managing your growth, managing your cash, because it's not as easy to raise money. And so today's panel is really discussing kind of where do you fall in that balance, what do we want to achieve, and then as you're scaling your company, what's the right time to start thinking about exit and how does that play in? So I'm really excited to introduce each of our 2 founders and an investment bank leader. So how about each of you give a quick overview of you and your company and what you're doing, any highlights you want to hit, and then we'll get into some Q&A. Ken, you want to start?
Sure. Kim Grider, Raymond James Investment Banking. I'll tell you, the firm has grown a lot. When I joined in 2009, we had about 100 investment bankers. We are approaching 650, and tech and services is our largest practice. So over 100 technology bankers on platform right now. I know that Danielle and Cam are sponsors of this event out of their wealth practice, which is exclusively focused on tech and tech companies and their owners. So I wanted to say a kind word for them. But I would say, with respect to the investment bank, tech is an important role for us, and I think our bankers are motivated and like to start relationships and plant seeds early. We can talk about how that works, but certainly happy to be here. And one nice thing I'm going to say, I've been in Florida for a long time, and new companies have a challenge. And one of those first challenges is capital, and all things that are new need friends, right? So we appreciate what this organization does and the companies you go.
Good afternoon, Jim Schiff, CEO and founder of Chatter. We help businesses hire hourly workforce. Companies like Waffle House, Kentucky Fried Chicken, College Homeschooling Junk. Omar, if you're here today, shout out to you. Thank you very much. As far as what I think and what's going on in the market is, we're early stage. We're a pre-Series A company. We raised 2 rounds of investment with our funders, so we're a 2-time partner. Very happy to be that way. We raised our first round in 2021 and then again in 2022, and just those 2 years apart, the climate has completely changed within those 2 years, and we're back out raising another round at this point, and from 2 years ago, it's completely different. So we'll get into that a little bit.
Hey everybody, I'm Aaron. I'm the founder of Roost. Prior to Roost, I was the founder of a company called Perch Security that was acquired by ConnectWise. Let's see, since 2021, we've raised $58 million in investment money. We're up to 60 employees, and we're tripling in growth every year.
We can be done.
Any other questions?
Steve, fun too. You're doing really well with these 2 companies. So the way I divided it up, I'm going to have kind of a part 1. Let's dive into the companies a little bit, and then part 2, I want to get more into let's gear towards an exit. So with Aaron and Jim, every company, every startup has to raise capital, but there's a thought process, and there's no right or wrong answer. But when do you want to raise capital? Obviously, you don't want to run out, but you guys have dealt with preemption. You guys have wanted to plan, and there's a trajectory there of growth, trying to maximize the opportunity of when you want to raise and be able to accelerate. So what are your thoughts there? When did you guys raise? Was it scripted? Was it planned? Go into that a little bit.
we raised our first round with you. It was a $300,000 early round, and we were coming off of 2020, and we provide hourly workers for retail, restaurant, and hospitality. I don't know if anybody had ever been out to a restaurant at the end of 2020, but you couldn't get a seat because there wasn't any workers to serve you. And so we were at a right time, right inflection point. Ryan and the group at Four Funders, they looked at us and said, look, you're onto something. We had grown 1,400% the year before, and they said, look, you've got an opportunity here to where you need to capture the market share and get out in front of it. And I was head down, kind of a grinder founder, that sort of profile, and sometimes it's hard to look up and see what's in front of you. And so it took mentors like Florida Funders to say, hey, look, this is a great opportunity. So we knew at that point, after raising that first $300,000, that another year of growth, which in the second year we grew 306%, that it was an appropriate time at that point. So
I think with seed rounds, it's easier to figure out. You may not have product market fit yet, you may not have revenue yet, and it's really about, as the founder, how much risk do you want to take, right? If you don't have a lot of capital, that risk may be working for free. That risk may be trying to grow a product without a team. So if you don't have capital and you want to get a small paycheck and be able to hire a team, you're going to need to raise a seed fund. But after seed, it's all about leverage. The investors are trying to get leverage to get as much of your business as possible, and you're trying to get leverage to get as high of a valuation as possible. So my recommendation is post-seed, like think Series A and Series B. You're not raising when you need the money, because when you need the money, you've given the investor the leverage. You raise when you are the most valuable to them to invest in.
And I think it's a little bit of a personal opinion too. I mean, it depends on where you're at in the business. I run the business very proactively. I look at line of sight a little bit further than a lot of founders that I've talked to. And even when I talk to investors, when I tell them the kind of runway that we have and the types of thought process that I'm having, they look at me. This happened this morning. They look at me and they say, Jim, you got plenty of time. You got plenty of time. So you got to have a little bit of a strategic approach as well as an intuition about how you're going to run the business. Because the last thing you do, that you want to do, like Aaron said, is you want to give up the equity in the company, but you know you need the right investor to be able to do that. And so we're constantly balancing that thought process as we look at raising new capital.
And that's exactly something we're bringing. Go ahead.
No, I would just say, okay, so cash is oxygen, right? It's the blood inside a company. So think about this. This is the way I think about it, in that once you start taking investors, once you begin setting expectations, right? Future investment is essentially a confidence play, right? So your ability to manage expectations and stay the course, or at least stay as close as you can to the expectations that you've set, right, becomes an important part of the game, especially for an early stage company. So when you think about timing to raise capital, the time to raise capital is before you run out, and the time to raise capital is at a level and a rate, and we can talk about the current conditions in a second, but they'll allow you as best possible to continue to hit your milestones relative to what your folks are expecting to the degree possible. That's true for a public company, and how about this? It's especially true for a startup company because it is a confidence play.
Yeah, I mean, that's exactly what we want to get at here, because there's a lot of founders in the room kind of struggling with this balance of growth at all costs, but making sure they stay alive, and it takes a while to get to know investors and run through their process and get a commitment letter. So maybe for any of you, like, what's your thought process there? I mean, Jim, you're a little bit earlier than Aaron is, and as we get towards the exit, I think that mindset shifts, and I really want to get Ken's opinion there. But as you're scaling your company in the early days, and as you're starting to get bigger and bigger, what's the thought process there, and how does that work with the board and other investors of balancing your comfort versus growth?
I look at capital a little differently. I'm a little bit more, my last company I bootstrapped, and we had no outside capital, and we scaled it multi-millions, and so this was my first venture-backed, capital-backed business, and so it took me a little bit actually to even make a decision to raise the capital, because I had originally started this company and bootstrapped it out of my own cash. And so when I took the funding, I knew that I would have a balance between a conservative approach, kind of a bootstrap, be a good steward of capital, and then also if there wasn't a proven system. A lot of founders at my stage, we're 2.4 million ARR. A lot of founders at my stage, we look at we're still in the building process. So if we don't have a proven system or somewhat of a remnants or traction around a proven system, there's no capital that's going to make it better. And so sometimes too much capital can exacerbate some of the inefficiencies and the holes that you have in your business. So you just got to be very careful about that. And I've always been very mindful in having line of sight when we brought new capital in.
It's not always growth at all costs, but at the beginning it is. So you're trying to get this leverage to raise a round. Investors, you're in your business, you're thinking about it 24/7, you're thinking about it every day of the year, you're thinking about your tech and your problems and your opportunities all day long. To you it seems simple, it seems obvious, but to investors who are thinking at hundreds or thousands of businesses at the same time, it's not that obvious. They don't have that much time to do that. So the only way that they see you as an investment opportunity is through your numbers, through your metrics. And that growth at all costs is what gets you out of seed to Series A, because that shows product market fit. You don't have to explain your product for hours and days and weeks and months to the investor. You show them your reports. You show them how many new users you're signing every day. How much in new MRR are you booking each month? This gets you the leverage. And then maybe after Series B, when you're no longer tripling in growth, you start to focus now more on efficiency. You've already captured the low-hanging fruit in the market. You've already won the land grab. Now let's focus on keeping them and maturing as a business.
Yeah, what I would say is we spend a lot of time talking to companies, right? That's unfortunately how investment bankers sell. We spend a lot of upfront time just trying to get to know companies and adding as much value and being as good a sounding board as we can until there may be the possibility we could do something with these companies. But to the extent you're talking about cash versus profitability, like cash wins every time, again, because it's the oxygen. Now the question is growth versus profitability. Now that's a bigger question, right? Because it starts to seep into value. It starts to seep into market share and growth. But how do you figure that one out? I think that's the question you're getting to.
Yeah, and as you're moving towards, and so there's a lot of different stages that the company's going through, but let's kind of take it to the next step. We all want to see exits here, and there's probably an optimal time. And so let's say the company started scaling, they're doing great. What is the company, when should they come to you? What does that look like, and what do you want to see there to optimize an exit?
Right.
That's a lot, but
Yeah, there's a lot of catchphrases you might have heard, right? 10 million in ARR, that's the golden ticket. Or profitability, if you get to profitability, that's a golden ticket. Or the rule of 50, right? What I want to do is I want to be able to have my EBITDA and my growth rate, and I want to get to that 50 number, to get it in there, to get a sense of what's valuable, what's kind of proving itself as a growth company. And all those things have been out there for a while, but the truth is, for every company, it's a little different, right? When you're thinking about profitability versus growth, listen, if you've got a wide open addressable market, and there doesn't seem to be a competitive engine in sight, and you are massively grabbing market share, land grab, you want to do that, right? And there are only investors or folks that will understand and will reward value to that. What's interesting in this market, and I think someone said like 2 years ago versus now, the capital sourcing solution, it's a very different type of environment. That's true, right? Because now you've got this investor base that is starting to think, well maybe profitability begins to matter. Well, where did that come from? Well, how about this? Reddit just filed to go public last week. They're approaching that kind of break-even level, right? Here's what investors see there. They see the ability to not believe that forever they're going to be funding into a black hole, right? That's what this profitability equation is all about. It's what is the checks that have to be written to ultimately get to that point at some point in time. So what we say relative to exits, is there something to that 10 million in ARR that opens up a larger institutional, if not strategic, kind of environment to chat with? Yes, there is, right? For a company that's focusing on land grab and is focusing on that growth kind of at all costs because the market is there and they can do it, what you still have to be able to articulate is a line of sight or a path to profitability, right? You either are going to try and be there, or you're going to have at least some general understanding of the thesis as to how you get there, right? Because that's what becomes important to that equation. But I think to pass the baton to some of these folks, what I would say is, from an investment banker perspective, and I'm referring to James Investment Bank, you talk to smart tech bankers, because that's how they'll try and guide you. And they're going to have a sense of that next level of investor, buyer. They're going to get a sense of your company, how that fit works with the investable market that's out there, and they're going to start guiding you relative to watch what's possible and begin looking at what cash you have when that runs out and start developing a plan for you that's either new cash or that next level type investment.
So, in my opinion, correct me if I'm wrong here, but there's a limited subset that's going to make it to IPO. But there's all sorts of strategic buyers, there's PE buyers. Is there an optimization there in terms of your growth rate or the profitability, that 10 million ARR number that you're talking about, that either opens up to everybody bidding on you, or is there an area where you've eliminated PE, for example, because you're not profitable? Like, what do these guys need to have in mind as other founders and business ownership?
I don't think in today's world we'll eliminate PE. They're going to find a way to get around, right, these assets. Historically, in a good market, 40 to 50 tech IPOs, we talked about that. I think, in 21, 90, and then 22, 23, getting into 23, about 6 combined. The IPO has always been a reasonable and good option for tech companies, and we're hoping, that comes back, and when this capital solution starts to fix itself, we get back to some more norms relative to those numbers. But I gotta tell you, a lot of what historically used to be accomplished in the public market is now accomplished in the private market, right? You get to these late stage rounds and you get crossover investors and these new funds that T. Rowe Price and these folks have put together and these new hedge fund buyers that exist out in the market. A lot of what can be accomplished historically in the IPO market can be accomplished in the private market and much more efficiently, right? So again, it's just becoming smart and developing a working group around you that you're constantly sonar pinging relative to, here's my capital solution, here's where do I sit relative to my value with this asset right now, what investors' capital seems to be available to me, and then continue reevaluating on, if not a quarterly, every other 6-month basis, what's available to me, and being ready to pull the trigger, but not necessarily having to do it.
So let's say, I don't know, this happens a lot to a lot of our founders, and it's a good thing. Company comes and they make an unsolicited offer to acquire you guys. Aaron, you sold your last company. What's kind of the thought process? I want to know what you guys, how you approach that, but then kind of what is the thought process that a founder should be looking at if they get approached? So Aaron, maybe, I don't know if you're willing to say anything on kind of the prior exit and how that came about and what you're thinking about for this one.
The exit went great. Part of it was because we used a banker. You may have a lot of connections. You may think that you can get and create a competitive bidding process for your business. But the problem you have is timing. You'll get that LOI in, and then you'll be going through your emails trying to figure out the corp dev folks from the other 5-10 people that you check in with monthly and quarterly, and try to get them engaged. Where the investment banker can manage the timing for you, collect the LOIs, as well as build market demand, maybe even pit some of the companies against each other using, fear. Hey, your competitor may end up with you, right?
Aaron, did you enter a process, or did you have somebody come to you and then you engaged a banker to help you with that process?
A little bit of both. I'm very opportunistic. Like, we weren't. I go at a fundraising round is a potential to get funded and have some of your equity purchased, or it's a potential to get 100%. You can also, depending on who the banker is, they can help you manage the investment process as well, as long as the investment dollar size reaches their minimums.
I think I just need to let him keep talking. And but okay, so how about this? How many times do we get a call because a stalking horse showed up and started the conversation about wanting to invest? That is one of the traditional catalysts that starts a conversation with a banker, right? And how flattering is it to have somebody reach out to you that is credible? I mean, you've done diligence, you've checked on, this is a great company, or private equity firm that's knocking on my door. That's exciting. You know what? If that's the first one or two that's come along, how about that? It feels really good. It's a confidence builder. But I would say to you, like in that situation, whether you use a banker or not, and I'm a fan, I'm biased, the conversation with the banker as to what they think about the approach, the options and strategies and structures that are available, and just their perspective on what the investor or buyer universe could be, is a lot of times very eye-opening. How many times do we meet a company and I know that there's 2 potential buyers strategic for my company, and 3 private equity firms that would be a fit. 99% of the time, if we run a process on that, it's not going to be one of those. It could be, but that's the value. The magic that a banker provides is bringing the market to bear, so you can look in the eyes of the potential suitors, investors, check writers, and buyers. And the bankers can try and tell you how great they are. They can give you references, but you know what? The rubber hits the road when you look them in the eye, and they're talking through what they think your partnership can be, where you can take the company together, and all of a sudden, it looks real to you. It looks like there's something more than cash there, and you think combined, we can really take the high ground, and there's something bigger we can get to with them than without them. That's when the deals get done.
Let's talk about where the process could go wrong. I think I'd like to start maybe with Aaron and Jim. What are your fears if you get to this point, when you get to this point, to go down the process? What maybe concerns you the most about that? And I'd like Ken maybe to elaborate on those real fears, or there's ways you can combat that.
I haven't been in that situation yet. We're still a little young, but my biggest fear at this stage is distraction. I'm in complete alignment with Aaron and Ken about having outside assistance managing and running that process for you, even if it's just a casual process. There's resources out there that are not official investment banking resources that are helping broker relationships, helping manage some of that process, the one-to-one relationships. So my biggest fear is early innings and being romanced on a potential distraction that really never comes to fruition.
So first off, I'm not for sale and neither are you. The minute you're for sale, your valuation plummets in my mind. With that, my biggest fears are my customers. How well will the acquirer treat my customers? And then I guess my next biggest fear is how will the acquirer treat the team post-acquisition? And then also other fears like around, how is the team paid out on acquisition, and then how is the team retained post-acquisition?
You can tell Aaron's blood pressure does not move when he's at the table.
He's a cool cat.
Still in the gold.
But he's done it before, right? So that's when you think about a banker, right? They're solving for value and what the on-paper outcome is. But then behind that, it's culture and fit, and then it's future potential of the partnership. Right? You're trying to solve, it's a multivariate equation. And if you do it right, you're trying to solve for all those. What the deal is papered, what it looks like, how it's structured, that makes people happy. The culture fit is good, that makes people happy. And my gosh, we got the gorilla, and that 200, 300, 400x, that's possible.
Right, so, as I mentioned, lots of business options go wrong. Where does it go wrong in the process and somebody totally butchers the deal of a lifetime?
I think I said earlier, this is think about early stage investing. It's a confidence play. I know it's a private equity partner, right? You're investing. What's the spend get? If I spend this, what do I get? Right? So through this entire due diligence process, it's really meant to be confirmatory in nature once they've looked at the materials. Sometimes they can go a little bit outside that. How you answer questions. Staying focused on the business so the business doesn't go wrong, or you don't go off script as this process is playing itself out. Certain value expectations, you gotta make sure value expectations on both sides are managed. But, there's, what can go wrong? I mean, the list is large, and it can be full of intuitive things and non-intuitive things, because you're trying to create a marriage here, right? We all know with relationships with marriages, you gotta feel good about it. I mean, the day before I got married, my father called me, who'd been married 3 times, and said, "Son, if you don't want to do this, or you have any concerns, don't do it," right? And I think my bride-to-be was actually on speaker when that happened. So that took a little recovery. Work, right? But it's a lot of different things, but you want good coach counsel. And I tell you, I'm a banker, but man, this takes a village, right? You want mentors, you want great counsel, right? You want great accountants. You want great personal wealth advisors and people around you to do this. And I'll tell you what, when you get toward an end and your whole chorus around you, and most importantly, you are looking at this thing and saying, I think this is right, you're probably getting close.
Okay. Got 2 questions before we get kicked off the stage here. One, I think everybody in the room is interested in knowing what's the outlook. I mean, the market's been frozen for a long time. I don't know if we need to GoFundMe for some of the bankers over there, but what does it look like? Do you see it unlocking? Do you see the IPO markets, the M&A markets? What's going to happen?
Okay, what I'm going to say, and $2 will get you on a bus, all right, relative to the market and what things look like. But listen, there is great hope, called great hope out there, that this scarce capital situation is hopefully turning and moving in a much more positive direction, right? Because everything ultimately translates back to ROI. Think about private equity, right? What I would say is, you got this pin, I call it the pinwheel out there, right? Private equity isn't selling a lot of companies right now, right? Because of values, because of what's going on out there. So those companies aren't being sold, so there's not massive capital being returned. When that capital is returned, the investors feel good, they re-up, they reload, and then there's fresh capital to invest. So you have this recurring cycle, right, that occurs out there. So you've got a lot of things that need to happen, but here's what we're hoping and we're thinking, right? We're thinking capital solutions gets a little bit easier, capital becomes more available, valuations start to move back in the correct direction, private equity on a larger scale begins to hit the gas pedal, and all these deals that are held up and waiting out there. I mean, there is a huge on deck. I mean, I'm serious. It's like a Disney, it's like you're trying to get on the dwarf mine ride, right, at Disney, relative to the companies that are out there that want to go to market. I think I was there with my kids with a 3-hour wait, which I think is unconscionable, right, for the kids, but that's what's waiting there. So if the cash loosens up, if the private equity starts loading the market with these opportunities, if the capital market solution starts to come back, and say the average year is 40 to 50, say this year we can notch 20 plus tech IPOs, and that loads up for a 40 to 50 kind of next year. That's what we're all hoping to see. That's what we should all be praying for, because there's I can't say trickle-down economics, but there's a waterfall effect here that will flow all the way down to the companies that are trying to punch into that system at varying levels and then begin climbing their way up the ladder to accomplish those same things.
I think we can all hope for that, and that would be great for all of our companies. I want to give you guys, Aaron and Jim, is there any questions you guys might have, or questions that you heard from others that you may want to ask about the process of investment banking or scaling a company?
See you in 2 years.
From your list,
It's all gas, no brakes at Chatter right now, so.
No, listen. Okay, look, you're doing the hard work right now. The founders that are here,
And I will say this, what I've definitely seen though is recently, if you're out raising capital, there are deals we make. And what as a founder, what you gotta be really, really careful of is being careful about the feedback and how you adjust the feedback. Because they're picking the business apart at every little lever. And that can legitimately get in your head on how you manage the business. Some of it is good. Some of it is eye-opening. Some of it exposes holes, and some of it exposes opportunities for you to look at the business a little bit differently. If I could tell you how many times in the last 6 months I've heard, "Hey Jim, I'm curious. How do you think about that?" And quite often I start to think about it a little differently. But you just got to be a little careful. And I would say that as people start to look at an exit and look at acquisition, and they start to romance you, and you start to go through that experience, keeping your lens open to the different possibilities around the levers that you're running. You just got to be really careful and protect your mind around that.
I like that. You're gonna get a lot of no's, but all you need is one yes. Right, so don't let the process, whether you're fundraising, you may get some extremely negative feedback, and here you are completely sapped of energy because you've been up 3 days straight. So you're going to get negative feedback, but all you need is one, and then all of a sudden, all those people that said no are like, wait a second, well, we didn't know it was a soft no. The no with a lowercase n, right? So keep your...
It's the no you get when you say, wow, thank you. Right, it's that one. And then what I would kind of end with is this. What he said is correct. You know, how fun is it to be Simon Cowell and criticize companies and point out the little defects? What I would tell you, though, where many of these investors and institutions are incredible growth partners, right? They can take a small flame, pour gasoline on it, and create tremendous growth and value. What they're not willing to do, in a lot of cases not able to do, is be the entrepreneur starting the business, right? That is a special breed, that is a special personality, and I've worked with nice people, and you know who you are, but that's something that I think this organization has really figured out, that these folks, I'll end where I started, that's who need friends, right? And you should be supported in what you're doing, because little companies become big companies, and to the extent there are companies that can change lives, improve lives, change industries, they need to be heard.
I'm dropping the mic on that one.
Hi everyone, my name is Kelsey Oppenheim. I'm the Director of Investments here at Florida Funders. Hope everyone's having an amazing day so far. And like Saxon mentioned, we have another amazing panel for you with the most buzzworthy topic of the moment right now, which is artificial intelligence. So without further ado, I'm going to let my panelists introduce themselves, tell us your name, a little bit about your company. Frank, we'll start with you.
Perfect. Hi everyone, my name is Frank Farrisy. I'm the founder and CEO of XGen AI. So XGen AI's mission is a big one. It's basically to empower the e-com and digital teams that manage websites and large amounts of revenue every year to directly deploy and leverage AI services and models like a developer would, but without the use of code or machine learning knowledge. So our customers actually train models themselves, even though they have no experience or expertise in how to do so, leveraging the best-in-class from a model library that we have in-house to pretty much solve any problem they run into when building specific services. Our philosophy on the market in terms of SaaS is that in e-commerce specifically, no one-size-fits-all. Problems are quite unique from the enterprise all the way down to SMB. And our take on this is customers should be able to build their own product. They should be able to compose what's right for them. Therefore, the customers that use our platform are given the capabilities to actually compose the solution that is their own IP, their own product, and completely different from the next customer. And they can do it in less time than it takes to deploy an off-the-shelf solution at the same price point with much higher returns.
Thanks, Frank. Joe?
Thanks for having me. Joe Partlow, CTO at ReliQuest. We are a Tampa-based cybersecurity firm focusing on security operations platform for the enterprise level customer. So I've been in InfoSec cybersecurity for 25 plus years. How we're leveraging AI in our security operations platform called Graymatter is really kind of using it more for automation. So how do we take cybersecurity incidents? How do we take our 400 or 500 cybersecurity analysts that are working on incidents every day and really empower them to come to a solution more consistent, faster, as well as for our customers to basically leverage that and take advantage of all the automation capabilities and just frankly kind of the new knowledge share of, especially kind of some of the new AI models that are coming out. So huge win for us. ReliQuest's been around for 15 plus years, but definitely with this new AI boom, it's kind of give us a shot in the arm on what it's capable now from an automation standpoint.
Amy?
Awesome. Hi everyone, I'm Amy. I'm the founder and CEO of Manifest. Manifest is a Gen Z mental health company. By leveraging AI, we create a daily mental health toolkit for personalized affirmations, personalized meditation, and traditional talk therapy. The thesis is really around the fact that Gen Z's mental health is declining in ways that we can all see across stats around anxiety, depression, loneliness. There's a massive epidemic that's happening here. Traditional talk therapy is awesome. It works if you stick with it. But Gen Z's attention span is sub 8 seconds, and Gen Alpha is even shorter than that. And so we're creating these really tiny, bite-sized dopamine hits that allow our users to start feeling better and build their self-confidence.
Awesome, thank you all. Well, it's been just over a year since ChatGPT has made waves globally and really sparked a conversation around artificial intelligence. But in reality, it's been under the hood for years and really shaping a lot of different industries. So I want to start with you, Joe, and kind of dig into how that conversation has grown and developed at ReliQuest and where you've seen that journey come from the start of AI to now.
Yeah, it's been pretty exciting. Obviously, we've had a data science team for a number of years and working on kind of traditional machine learning and things like that. And like I said, ChatGPT it's been around for a little while, but when it got released at the end of 2022 to the public and made it more accessible to everybody, that's when we really kind of started to take notice. So, over the past year, we have really been ramping up our data science teams to kind of pivot more to that to see, hey, how can we use these generative AI models to get a result faster? And that's kind of the biggest thing that we've seen is that it doesn't take the place necessarily of traditional machine learning and data science, But what it does do is it gets a little bit faster results, and kind of like we were saying earlier, it's enables, I don't have to have data scientists that are now building models and using models. Some of that has been kind of abstracted away from that. So it's been a huge gain for us just to really kind of empower our regular development team to be able to kind of use these models and really get the outcome of it. We're not an AI-specific company. We're in the business of cybersecurity. So that's the main thing that we still focus on. But leveraging AI to get to faster results, more consistent results, and really to level up really all areas of our business. That could be our developers that are making our product, making sure that they're doing better quality code, more consistent code. Also for our analysts that are watching and reacting to these security events that are happening pretty much across all of our customer base. How do we fill in knowledge gaps for them and react faster? I mean, obviously in cybersecurity, speed is the name of the game. So as fast as we can react to ransomware or phishing attacks and things like that, the better it's obviously going to be. So that's kind of really been the big win that we've seen, at least over the past year, with kind of the quote-unquote new generative AI models. It's really making that accessible to really our whole team.
And then Frank, you just recently came out of stealth mode, congrats by the way, but tell us a little bit about why is the time now for yourself or other startups in AI? What is it about this market that is exciting for you guys to launch right now?
Yeah, awesome question. So I think what we face today as far as AI tech stack and technologies is unparalleled to any point it's ever been in the past. And AI technology has always been available, it's always been growing at a rapid rate. I think, a lot of people are saying, oh, well, AI has really started to take off now. Well, it's actually always been that way. And what is really empowering the next generation of AI users is opening up the user base who can actually access these technologies and use them directly. So, ChatGPT is obviously a great example of this. But what you're going to see is a huge shift in the ecosystem towards AI systems that can be operated and managed by people that are not developers, right? CEO of NVIDIA was talking about this a couple of days ago, and that shift there is really a powerful time to come out on the market and say, hey, we are on this wave. We can provide a team or people who are managing a huge budget in e-commerce or digital environments to actually use this technology when they've never had access to it before. So if you can comfortably come out in the market and say, look, you can actually finally do this, and you've always wanted to, but you needed like a huge $10 million budget a year to spin up a huge ML team, site reliability, the whole 9 yards, and then someone else is coming along saying, cool, you can actually do this by yourself now. I think that's incredibly empowering because it's not just about selling the company AI or getting them to use it, it's about turning that individual, let's say an e-com manager, into the next generation hero within the company who is the new AI expert. And I think that natural progression of growth is going to continue to exponentially explode in the market, so we're excited to ride that wave.
And then Amy, you're sitting at the center point between two really hot topics right now, both AI and mental health. Tell us kind of about the intersection of those two and how you portray yourself in the middle of this landscape.
Definitely. There's a couple really interesting trends as it relates to both mental health and AI. I think the first is as it relates to healthcare. AI allows the democratization of access to high quality healthcare. Now, if you look at America, just in America alone, about 20% of Americans do not have access to a regular healthcare provider. And that's just for overall healthcare. For mental health, those stats are even worse. Now, in the realm of a more, accessible, pocket-ready AI, you can have access to the best-in-class professionals for mental health across therapists, coaches, gurus, across different styles of therapy, different frameworks, and you can have that all in your pocket on a device or a computer that you already have, and that access is game-changing for most Americans. The second thing that AI allows us to do is to have personalized longitudinal data for each individual. So if you think about the realm of AI, humans today cannot even recall all information. But now we can have personalized recall, almost near perfect recall on everything that you've said in your life. So as it applies to mental health, if you think about it, if you get in a fight with your partner on Friday, that's not a standalone incident in your life. Maybe it relates to your childhood, maybe it relates to the fight that you had last year, maybe it relates to something that's going on at work or stress and career, finances. All of these things are tied together, and AI allows you to connect the dots between those different subjects in a way that traditionally humans have not really had access to. And the third thing that I think is really interesting about mental health as it relates to AI is simply around cost reduction. If you think about mental health, a traditional therapy session, people are only going once a week, once a month, maybe once a quarter. It costs anywhere between $80 to $400 depending on if your insurance provider is paying for that or covering that for you. That's a cost amount that most people cannot afford to do regularly. At Manifest, we do this on your phone. We do these bite-sized interactions. People talk to us over 30 times a day, which is insane. And that's a level of access that someone has to a mental health resource that wouldn't have existed prior to AI.
So I think it's clear with our three panelists up here, all very different industries, very different types of businesses, that AI is kind of just democratizing business as a whole. It's becoming ubiquitous, but let's dive a little bit deeper into use cases, applications. So Amy, I want to stick with you. At Manifest, AI is under the hood, so your users might not realize they're interacting with AI. Tell us a little bit more about that and why that's important in your application.
Definitely. So this is really interesting. Manifest has been around in a closed beta for about 4 months right now. It's in 71 countries, which is crazy to me because users have just referred that out to other individuals and people have gotten their hands on it as they've got really excited about it. I don't even know anyone in 71 countries, so I have no idea how that even happened. But it's pretty cool. We actually don't tell anyone that it's AI. And we just advertise it as, hey, if you want to go talk to someone, if you want to start feeling better, if you want to start building self-belief in yourself, then you can start using Manifest. And that's allowed us to create this feeling of magic for our users, this feeling of delight, this feeling of, oh my God, I got this response and no one else in the world would possibly have been able to respond in that way because how did something understand me that well? On the back end, we're looking at every single thing that you've said to us, the history of everything you've said to us, chronologically how your life has progressed. We're looking at your infinite feed, we're looking at how long you've spent on things, clicks, likes, saves, shares, all of that better informs us on what the user is going through. But we use that, and we don't even mention AI at all because I fundamentally believe, and I'm sure a lot of people in this room will agree with, every company now is a tech company. And every company very soon will also be an AI company. And so, really creating these moments of delight leveraging AI, but not leading into the fact that we are AI for the users to create that magic.
And then Frank, I know something that we've talked about previously is the importance of vertical AI versus horizontal AI. So for our audience, just tell us a little bit about that. Why is it important in AI specifically to go deep versus to go wide?
Yeah, super good question. So there's a lot to talk about here, but I'll keep it concise. So if you zoom into the AI application, unpacking what it is, ultimately you're grabbing data, you're finding an algorithm that is honestly just doing a bunch of math, keep it really simple, and it's doing it on someone's computer somewhere, right? So it's a processor that's running full speed, as hard as it can go, to run these algorithms, okay? And the output is commonly predictions about something that you're feeding it. So diving into that, a common principle with conventional machine learning is that the closer you dial it into the data set, and the more you dial in the data set and make it more effective, the more accurate those predictions become. Taking something common like the stock market, if you could predict the stock more accurately using algorithms, you could make more money. Now, the problem we're facing in AI application these days is that with the wave of generative AI and large language models and all these amazing tools, Claude, Titan, ChatGPT coming out, these are all trained on very wide data sets. We're talking in the region of like terabytes of information. To give you some context, I can train a machine learning model in 20 minutes to an hour, and it's ready to go. It's ready to predict. It's my AI child. It's ready to do its job. Some of these large language models take 3 months to train continuously. They can cost up to $20 to $30 million just to train in power costs, which is a big difference, right? So you get the idea on the size of data. So when you're looking at that context, you start to understand that you really want to train horizontally. You want it to be applied in e-commerce and different verticals. but the fundamental paradigm of accuracy within a vertical still exists. So you're not trained for a specific target. So what's happening in the industry right now is the application of LLMs, even some of the newer ones from Anthropic, or even AWS like Titan, very powerful tools, but when you really dial them into a specific use case, you get all this wild stuff happening. Anyone here played with prompting before on ChatGPT? Okay. So if you ever tried to prompt it too much and go really deep on prompting, you've ever seen it hallucinate before? Like start to invent facts. Have a physics conversation with it all the way down. It's going to blow your mind. It'll start inventing things about physics. So that's obviously, hallucinations are a real thing with these LLMs, and that's a problem. So vertical AI is, and Bill Gates was on a podcast with Agent Cho, a prolific AI researcher, a couple months ago, and he basically said, this is going to continue to be a problem because of what we're thinking about as far as the data set goes. So he said the future is in a vertical application of these systems, and it's not just the model, it's not just about Claude or ChatGPT, it's, you know, I jokingly say MLMs, medium language models, designed for smaller data sets. It's about the whole tech stack that has to be used to deploy a model, because believe it or not, a model is like 20% of the game. Building the actual pipeline for that model to operate is actually the hard thing these days, right? So vertical AI to me is really about empowering the specialist within a vertical. It could be anything, it could be insurance, it could be consumer banking, e-commerce, retail, whatever you're doing. It's really about, one, having models that they can deploy that are very highly accurate in the job they're deploying them to, and also automates the machine learning process for them to deploy a model. That means speed, accuracy, results, and a lot less money spent, which is ultimately what everything comes down to at the end of the day. Yeah.
Amazing. And then Joe, I want to pivot to you from a different kind of lens at a corporation. Where are you applying AI within ReliaQuest? What types of use cases are you seeing?
Yeah, so I think initially, like everybody else, kind of the chat-based applications were there. And that's cool, it was a novelty, you know, people had fun with it, but for us, that's probably the least interesting use of this. Now, if you're in customer service, that's a huge win, and you're gonna be able to use that, and it does a phenomenal job at that. For us, it's more around automation, right? So if you think about kind of what we do from, you know, just a cybersecurity standpoint, that's our main use case is how do we bring in those events, how do we summarize those events, and maybe I'm an analyst that doesn't know AWS as well as I do Azure. So that's a big one for us is to fill in those gaps. But there are other areas of ReliaQuest that are not technically focused, right? So our help desk, they find chat extremely valuable for their use cases. Our training teams, our marketing teams, being able to kind of ask, you know, our models, hey, what are the top, you know, 5 training topics in cybersecurity this week? And then, you know, use that as a marketing blog launch off point. So even within our company, like I said, our main use case is not necessarily chat. It's more the automation of the data coming back for that. I think all of our other teams within the company have probably benefited the most from chat, you know, from a marketing standpoint. We're also using it for you know, training, to create training materials. So again, we're in a very technical position. Not every one of our training team is a cybersecurity expert. So in the past, that meant going to one of our, you know, other teammates, asking them a bunch of questions of, hey, how does this cyber attack work, and how do we defend against it, and what should we train on? That took a lot of time. Well, now that trainer can go ask any one of these LLMs to do that, and get a much, you know, clear, concise agenda. And then, you know, maybe that gets them 90% there, and then they have something technical kind of look it over. But just the advances that we've seen probably just in the last 6 months, I would say, that's becoming less and less reliant. You know, like Frank mentioned, kind of these MLMs, I'm going to steal that if you don't mind. But that's key for us, right, is that context, right? Hey, you've got kind of these large models that have been trained on, you know, all of the internet, right, and whatever the internet knows, but a lot of what we deal with is proprietary. So how we handle incidents, how we handle security, our proprietary processes for how to do stuff, being able to build a smaller model or embed our context into one of these models is key for us. So like I said, for us, since we're not public facing, the chat wide open function isn't as useful. It's that extra context really across all of our, you know, our accounting team is using it for assisting with forecasting. You know, some of our other our recruiting teams are using it for, hey, what are the top trending cybersecurity skills? Now you do have to watch out for, obviously hallucinations we kind of mentioned, but also where the model's trained. Since some of those models do take 3 or 4 months maybe to train on the data, you got to make sure you've got the latest relevant data. That was a problem for us since we deal with a lot of threat data. That changes by the hour sometimes. So we augment that with other models that are pulling our own data. So not just LLMs, we do kind of still merge that with our traditional machine learning models. But like we were talking kind of in the earlier question, the speed and the enablement of everybody in our company kind of being an AI user and creator has been kind of the biggest win.
So clearly we're seeing the prevalence of AI everywhere, but what does this mean for investors and business owners in the room? I want to open it up to our experts. What guidance do you guys have for investing in AI? What should we be looking for? What should we be keeping our eyes out for? Whoever wants to start.
I can take this from the business owner perspective. If anyone's thinking about implementing AI within their own businesses, I would say, A, you definitely should, because I would say you have a competitive advantage over anyone that you're working with in terms of being able to forecast trends, have personalized experiences with your customers, create better experiences for whatever that end customer is, and really tailor that down to the individual. I think that capability to create that really wonderful, delightful interaction, whether you're a B2B business, whether you're a B2C business, is now available with AI, so definitely leverage that. I think if you're doing that, and this has been a conversation I would say in tech for a long time now, is to be super data driven and to really look at what are you measuring, what do you want to get out of this, what is the data that you're putting into your LLMs, how are we fine tuning your LLMs, think about how comprehensive that is, whether you're getting the outcomes that you want, because at the end of the day, in all things with AI, as we've all kind of been saying here, the data is king. And so to the extent that you can be more proactive with your businesses rather than reactive and really, to become as data-driven as possible, I think that's really important. And then not to just take that in a silo, but overlay all of the qualitative that you see. Because if you are getting feedback from your customers that something is not what the data suggests, then maybe you're measuring the wrong thing, or you're looking at something the wrong way, and that all kind of impacts how these data-driven decisions impact your business. So I definitely just kind of give you the advice to dive in and start measuring.
Yeah, we've been fortunate enough to kind of see both sides of that coin. So our investors, typically what they're asking of us, not just of AI, but like any kind of tech trends, and certainly AI right now, a lot of it is, since we're not a specific AI company where that's our product, they want to make sure, hey, is this going to interrupt or be a deterrence or a disruption for your existing business? So how seamlessly were we weaving it into our normal business operations to basically just not kind of disrupt the current workflow and things like that we had. So time savings, how easy is it to adopt? What's the value that we're getting? The time savings was probably the biggest one for us. The consistency and accuracy, how sticky we are in customers because of that. Where do we pass it along to the customer? So from our investors, that's kind of what they're asking. Now from my position as kind of CTO and running that team, how do I make sure that we're getting that value back to investors, right? Because they're looking to us to say, well, hey, are we using that cutting edge technology? And frankly, it's been kind of like the biggest gift ever to us. And if you look at kind of last year, just given what we do, the fact that now we have no better way in history than to automate fast and consistently, really enabling our teams. It's been a great kind of tech gift from a technology standpoint that we can now show value back to our investors. So, hey, look how much better that we are operating our business. Look how much better we can get out in front of the clients that we were normally dealing with. So it's been interesting kind of be on both sides of that, of having to, hey, how do we show value to the investors off of kind of the investments that we're making and money that we're putting into our AI initiatives, but then also from the other side of making sure that getting asked that we're part of a growth fund, and it's always interesting. We have a lot of conversations on whatever the latest and greatest tech thing is, and I haven't got asked in my whole career, more than what I have been getting asked about AI. I'm probably on 2 to 3 calls per week with our customers, and then probably on every other week basis with our investors in their group on just what are we seeing change. Everything's moving so fast. This time last year, a lot of our customers were a little bit worried of, well, hey, how are you guys using this? And we're worried about data getting out and fake, hallucinating responses and all that. Fast forward to this time this year, it's been, hey, we're not looking at vendors that don't have AI as part of their product roadmap. And how can you guys have been down this road, how can you help us with our AI roadmap? Which has been an interesting conversation from how sticky we are, and of course the investors like that.
Awesome. I have a lot to say about this. Look, let's unpack AI for a second. Artificial intelligence. First of all, it's everywhere. Okay, it's in the processor of this TV here. It's in our phones. It's in every digital device we think of. It's most likely in that camera. The receiver that's receiving my audio signal right now is most likely using AI to process multiplex signals, so drown out noise or signal noise on the RF frequency spectrum. So when you start to look around the world, you're like, wow, it's actually everywhere. Okay. And the first thing I want to say is artificial intelligence is not actually intelligent. Unpopular opinion, but it's not. It is not up to the people tend to think it's like, oh, it can answer all our questions. It can do everything we want. No. The amount of work that has to go into deploying something to do what you think is, wow, it's talking to me, is unfathomable, right? So I think we will get there over time, but just really the concept should be right now is one, AI is a tool to predict, automate, and assist you in your goals, right? And if you know how to use it, it's amazing, it works great. On the reverse side of this, understanding that AI is in use everywhere, what I find the biggest problem is AI is going to become like the context of the internet, okay? When you first heard about the first web page coming up, people were in shock, didn't understand it. But from an investment standpoint, and not that I'm providing advice here because I can't, I'm just giving you my thoughts, the context is very simple, which is it's not enough to just say AI anymore. And if I was investing in and putting my money behind something, I would definitely want to know a bit more than just AI, the word, okay? First of all, there's many subcategories of AI in different fields. Then you break down those subcategories, there's other subcategories. Then there's more cutting edge R&D subjects like quantum AI models, right, which is under research right now. So when you start to look at this, you really get the concept of like, okay, I need to look behind the curtain a little bit, okay? And one of the things I always talk about is who owns what, because this becomes very powerful. If you do an exercise in diligence and say, okay, I've got a company that could be interesting, let's dive right in and see what they're doing technologically. Anyone can ask, tell me what you own, tell me what's open source, and tell me what you have actually built that is not an AWS, Azure, or GCP tool that you have actually coded, right? That represents core IP. Yes, you can build something on AWS and have it run, but ultimately, a lot of people can do that these days, right? We're talking about defensibility. You can take a 16-year-old dev who can spin up an app rapidly like this using AWS. All they're doing is plugging in AWS existing products to make that work, right? So understanding a little bit further than just the word AI is going to go a long way to really getting to understand what this company is going to become in terms of true value, right? And I think that's incredibly important. And the other topic to really dig into here is AI is so much more than just a model. All the way up at a computer. It's all in hardware. The genesis of AI comes from hardware. Without the hardware to run these numbers, none of this happens. So the demand for compute power is skyrocketing. Anyone heard about Sam Altman out in the Middle East asking for like $7 billion for a new compute farm? So you get the point, right? People are definitely going down that path. So innovation to support AI, the infrastructure, not just the model itself, all the way down to how long does it take to deploy a model. I'll give you an example. If I take my dev team and we start from scratch and we go, we're going to go to Hugging Face, which is like a place to find free models that you can use for all kinds of things. We say, we're going to take this model, we're going to build a cool app out of it. It could take us 6 months to do it, right? That is no longer acceptable. Meaning, this is the challenge, because there's companies, not to be facetious, like XGenAI and even ChatGPT and many other tools coming out where you can say, hey, without actually much knowledge, you can do this in like 1 week. Okay, so time to market is huge value. So going down the value chain, believe it or not, the value to me is no longer in the model itself. There is huge value there, but like, who's going to compete with Anthropic these days, right? Who's going to compete with OpenAI as far as AI R&D in building models? And I think that generally trained models, going back to the previous topic, are going to be very difficult to compete with. Yes, you can innovate new models and new spaces, that'd be great, awesome, but it requires a lot of work. And my opinion of this is providing accessibility, meaning the carts and the pickaxe in the gold rush, not the actual gold itself, is almost more valuable here, not these models, in my opinion. So I would just, caution anyone to just take a step further. Just be like, it's okay to ask questions, and it's okay. You can tell from people's reactions if they're flustered by it, which they shouldn't be. And the other context here is, I don't have a degree in computer science. I'm self-taught. I did not go to college, okay? But I can answer, and I can talk to you about system architecture and tell you how to build an AI system from the bottom up. So the point is, it's not scary. Anyone can dig in and understand it. There's little explainer videos on YouTube that will arm you to understand what's going on. So I would highly advise just digging deep yourself. It's not complicated. You'll understand a lot better. And you can ask questions on calls that a lot of intelligence calls. A lot of people are like, wow, this person actually knows what they're talking about and is willing to dig in deep. And sometimes you'll find founders really get excited by that in particular. So
So much great insight from all three of you. I want to wrap it up by talking about some predictions for the future. We're still in the early innings of AI, but what are some emerging trends or breakthroughs that you three see are going to bring us to the next innings?
I think one thing that's really interesting in the last couple of years is we've lived in this V1 era of the chatbot. I think one of you guys mentioned this, but I think it was Joe, but we've lived in this era of the first version of a chatbot, and I think there's a ton of room to innovate on where that is today. Today, you're opening your computer, you're probably pulling up GPT, you're asking it basic questions. It's all via text, or predominantly via text right now, is the predominant use case for people. At Manifest, we think a lot about voice. For all centuries of humanity, voice has been the mode of communication for humans. There's a lot of psychological studies that show that when people go and talk about their problems, talk about their relationships, talk about their feelings, that really helps them process what's going on in their lives. And so we've used a lot of different speech-to-text models. We've also really focused on that aspect of things. I think you'll see that more as a modality as we move away from this traditional text-based chatbot. So I think that's something that's super interesting. I think another thing that will come up is all of these bots, agents, however you want to define it, will continue to get more sophisticated. So in the context of how we think about this at Manifest, there's things like voice analysis. Can we start looking at your pace, your stuttering? Can we start looking at, how are you actually looking at actual emotions? And then can we start tying that to physiological data? So you might be talking to us a bunch about how you're having problems at your career or your relationship, and then your step count is decreasing, which we can start seeing through your Apple Health Toolkit. And then we can start looking through your Aura or your Whoop at your sleep scores, and we can start looking at your 8 sleep to figure out how restless you were at night. And all of these things, I think, better inform us in terms of how that end user is behaving and what the more holistic view of their life is. And then I think all of the AI virtual agents that support them, and I don't even just mean this in a mental health perspective, I just mean this in general, because there's going to be, all sorts of different buddies, companions, doctors, coaches, across all different spheres of people's lives that I think will get much more intelligent over time. And that's kind of one of the things that we are very acutely watching in our category, is this rise of, hey, what does that companion-esque figure look like? And I think it's super interesting, because if you think about humans, you don't just have one human relationship. You have, someone that you might call about sports, and then someone else you might call for a medical problem, and then you have someone else you might call if you're trying to figure out how to change your car tire, and everyone has different expertise. And I think the different agents in AI, as we move out of this kind of V1 chatbot era, will continue to get more and more sophisticated per person. And I think it's a very interesting world that we're going to grow up in, and that people's kids are going to grow up in. So excited to see it.
Yeah, I definitely think I agree with Frank. Kind of the models are a commodity at this point, right? It's everybody's got a model. Really, the value is the data that you're adding to it for extra context and the integration point. So, kind of where I would see in the future of AI is kind of a funny question, because that's that could be 3 or 4 months out where you have a massive shift. But what we're seeing, at least in our space, is I agree with Amy. Like we're barely scratching the surface of kind of what is available now, or what could be. So if you take this notion of like autonomous agents or plugins, people call them various things, but really what is the AI going to do, right? So at the end of the day, at least for our use cases, we need to get to an outcome. We need to make a decision, we need to do something. The AI can certainly help us get there, that model can certainly help us make those decisions, but integrating that in with other tools to do other lookups or call APIs to do other actions to quarantine a host or help kind of control some ransomware. So that ability to kind of integrate with other existing tools, from thinking about like an automation workflow standpoint, the ability to kind of take some of that decision making away from not only the creator of these workflows, because that's where a lot of times most automation workflows will fail, because you have to come up with every single scenario and hard code that in. And dynamic, environments are dynamically changing. So how do you make sure that you are accounting for every scenario? Having these models have the ability to kind of make basic decision points, and again, that comes down to the data, right? The model is fairly dumb when you think about it. It has to be kind of taught something or trained on a set of data. And the more context you can add for that is where we're seeing it. So I think just kind of a quick answer would be just that decision-making process. How do we get more proactive on, especially in our arena where we're looking about security alerts and security detections, proactively creating those based off of behavior. Not to get all minority report on everybody, but that's kind of the area that we see that is how do we start getting more proactive, just because of the sheer amount of volume of data that most of our analysts have to look at. Obviously, a model can shoot through that pretty quick.
Awesome. Yeah, I'll keep it quick. So I think that for me, the focus in the future of AI is really about enablement of using AI itself, right? So that goes all the way back to data centers. So better compute power, better servers that are designed to run AI algorithms cheaper, more effectively, which ultimately goes back to how much money you're spending on power, right? Which is an interesting concept because at the end of the day, AWS, Azure, and Google are taking a percentage of every dollar in tech right now, everything, because all the compute power goes back to them. And then that's all going back to the power companies, right? So not to get all, minority, don't want to do like a Star Trek on you, but fusion power. I no joke, would highly recommend looking into it because, just a few weeks ago we had a first 5.2 second sustained fusion reaction in the UK. The power mass is becoming critical, meaning the amount of compute power needed, both from crypto in the beginning, from all those bloody Bitcoin mines popping up everywhere, sucking up the world's power. Next to AI, it all comes back to that critical mass of do we have enough power to support these systems, right? And it's that those conversations are starting to occur. So believe it or not, I happen to, I have another interest in aviation and the space industry, and I happen to be quite connected to that scene. And you don't understand how much money these companies, NASA, Airbus, are starting to put into fusion power. Like it's becoming a reality. So I always tell people, hey, if you can throw $1 into fusion energy, that's a big one.
Okay, welcome everybody. Thank you so much, Cathie, for coming. I'm so excited and honored. We're honored to have you here.
I'm happy to be here. Thank you.
I was going to try to do some kind of introduction, but I don't know if you need an introduction. I think everybody knows who Cathie Wood is, right? I mean, arguably the most famous technology investor on the planet.
Andrew, I'm standing, and I really am on the shoulders of the most amazing research team, I think, in the world. the way we've set up our research is so different from most. It might be very similar to how you set up your research in the venture world, but in the public asset management world, and we're also in private, separating or organizing responsibilities by technology, not by sector or industry or sub-industry, is one of what I believe will be, in hindsight, the secrets to success.
Well, that's interesting. I want to talk about your big five. We're going to get to that,
Yeah.
your 5 platforms. But I thought I would start first by, as Saxon said, you moved down here during COVID.
Mm-hmm.
My understanding, you did an extensive search across the country for your new headquarters, and you ended up in St. Pete. How did that happen? Speaking of research, you did a lot of research on that, right?
Yeah, we did. But the search was narrowed quite a bit for one reason, which may not surprise you, of course, taxes. So that limits us.
We love taxes. Except for real estate.
And yes, we did tour around and considered Charleston, Jacksonville, Miami, maybe for a minute, the Tampa Bay region, Austin, and we chose this area because as we were touring around, we felt the innovative spirit, the optimism. I keep using that word as people trying to say, I used to use the word joy, and I feel that's a personal feeling. I feel joyful being here, and I feel this is a place of joy. But optimism is, I think, what we felt, and it's just a vibe that we felt. And the other thing, and this I would put up there in importance, is we felt we could make a difference as a company to an area and really help transform what we think will be the next Austin, but in its own way. We could be a big part of that. So. Okay,
so did you look at Tampa versus St. Pete? And I'm just kind of we don't have a dog in this fight, but we're Florida Thunder. We don't even have a dog in Miami fight or
I'm happy to tell you the story. So we came to Tampa, met with Jeff Vinnick, saw the 3D printed rendering of Water Street and how the area was going to develop. And honestly, so Tampa was one day and St. Pete was the next day. And so when we got done with Tampa, we said, okay, this is where we're going to be. This is where we're going to be. But we have to go to St. Pete because they've really planned a whole day, and
you fell off.
Yes, and got to St. Pete, and that vibe there a bit, but also a greater need, for a company to come in and make a difference and attract other companies. I think there was a greater need there, and we felt it, and I thought we would be in Tampa after touring here, but for that reason we ended in
I want to know about that phone call to Jeff Vinnick.
No, Jeff was so gracious. He said, I think you should pick Tampa instead of St. Pete. And this is before we made our decision. This was when we met him that day. And he said, but if you choose St. Pete, that's okay too. It's a Tampa Bay region.
Well, we're grateful to have you here.
Yeah,
so glad that when we look at the Tampa Bay area. So.
Yeah, and we love also what Dunbar Collective has done, what you're doing. Again, just there's a vibrancy in this space, in this area, and we think it's only begun.
So we're Florida funders, as you all know, and you do, Cathie. So we're very focused on technology in Florida. I think the audience would be very curious as how you look at the tech scene in Florida, and give us the good, bad, and the ugly. Tell us good.
I'm not going to tell you anything you don't already know, right? Infrastructure, transportation is an issue. But, innovation solves problems. And so when we think about that as an issue, we think, okay, well, maybe we should suggest to the mayors, go fast forward when it comes to autonomous everything, autonomous taxi networks on the ground, you know, when the FAA relents more, air taxis and other drones for delivery. So I'll just throw out a stat. One of the biggest problems, definitely in St. Pete, but I'm sure it's true here as well, is parking. For every car in the United States today, there are 5 parking spaces. With autonomous, when we go completely autonomous, which isn't going to be, take a long time to get there, guess how many per car, parking spaces per car we'll need?
1/2.
Oh, gosh, it's 1. Yeah. Now, that was that, okay.
You threw me a softball.
Yeah, no, but then.
5, 4.
But then, no, but you can think about solutions to problems. So you've got the boring company. Why not put, you know, a channel from Tampa to St. Pete? You know, I do love the way that they've done the infrastructure, you know, connecting, but, you know, put something underground over the air. So I think that a lot of the problems that innovation will solve. Education is another problem that we intend to be a part of helping solve. So we are arts research, made age appropriate by educators, is the 6th grade science curriculum throughout the public school system in St. Pete. And we would like it to spread throughout Florida, because capturing young people at this age especially, it's tough. It's a tough time really to start. But inspiring them at this age to catch a big wave associated with technology, which they're more tech native than I think many people appreciate, is very important. You know, the talent pool, the pipeline for technology in this state, I think we'll be able to grow from in-state, which is something I don't think many people have said.
Well, uplifting, education is uplifting you. I'm sure everybody in this room has agreed with you how important it is reaching people younger. You brought up the robo-taxi thing. I got to ask you, I just finished Elon's book, I was telling the audience earlier. Yeah. And so he's been saying since 2016 we'll have an autonomous vehicle in the next 18 months. Since 2016. So when do you really think we'll have an autonomous vehicle?
Well, it's very interesting. In his last call, his last earnings call.
You're his largest stockholder, aren't you?
Oh, no, we're his most visible. We're a little teapot of a company. We manage about $30 billion. You know, so normally in most multi-omics companies, so in the life science space, we'll probably be the largest shareholder. If we've committed, we're usually the largest. But Tesla is such a big company. We aspire to being the largest shareholder of Tesla. So in the latest earnings call, Elon, for the first time, said, I'm not going to give you a time. I know I've been wrong. I know I've been wrong every year, which gave me great hope. It's
getting closer.
Yeah. So we actually think it will be, you know, within the next 2 years. We're getting safety data on Tesla, FSD, with FSD, without FSD. So can I just give you some of those metrics to show you how important this is? So there are somewhere between 40 and 45,000 people who die on the roads because of accidents every year. And that number has gone up from the low 30s when we started ARC in 2014. So data is moving the regulators now. So here's a safety metric. The number of miles, this is surface streets only, this is not highway, surface streets only. The number of miles between accidents, not include just fatalities, but all accidents, on surface streets for the average car on the road is about 190,000, right? If you look at a Tesla without FSD, none of that, that number is 600,000. If you look at it with FSD, that number is 3.2 million. Wow. And so it's been really interesting for me to go around the country, and there's this backlash against EVs and autonomous and everything. And it's more, I think, in conservative circles. I was at an event and well, let me ask that question here. How many people own a Tesla? How about any electric vehicle? Everybody? Yeah. More here than in that group in New York, much more. By the way, 10%, the penetration number as a percent of sales is 10%, right? Maybe a little less than that in the US. So those safety metrics, I think, are going to sell this alone, and it's definitely impacting regulators. So he's going to want to go national. Waymo is going city by city. From an AI point of view, and this is the largest AI project in the world, the better way to do this is just do it nationally. And we think it'll be this year or next year that they will launch. They're already hiring people in different cities, getting ready to do it.
Well, it's exciting, and like you said, that we can reduce the death toll. Waymo is Google's competing product. How far behind are they? Or do you see them as behind Tesla? Just kind of curious.
Oh yes, they're very, very far behind. The way you know that is in AI, data makes the difference. That's it, right?
Yeah, they don't know all the data.
So Tesla has orders of magnitude more data of real-world driving, not simulated, real-world driving data. Tesla has orders of magnitude more than Waymo. I have been in a Waymo vehicle, and it's fine, it works. I think Tesla's going to be a lot better. And the reason is, when you collect it has 5 million robots out there collecting data right now and sending it back every day, and they don't care about most of it. They do care about the corner cases. And you can only get the corner cases, things that happen just so rarely, with billions on billions of miles of data.
Yeah, Elon talks about that, how he's got more data than anybody between Twitter and between...
Yes.
I don't want to spend too much time on Elon, but I do have to ask you about Twitter. Like, isn't this a big distraction? I mean, he seems to have really got himself into a mess here with Twitter. What are your thoughts on that?
Well, from the down rounds, you would think so, but and we own it. We own it. You know what? We're trying to find more. No one will give up any of their stock.
No you talk to Jack Dorsey.
You know what? It's a good question. I should do that. I never thought about it. No, in terms of he started in the payment space. That was his first big hit. He sold it to PayPal, and he wants Twitter to become the WeChat Pay of the U.S. Certainly. We'll see if it happens. Square has just made some very dramatic moves. We own that one as well in that direction. So they're coming at it from very different angles. We do think the kind of data that Twitter or X is collecting, much less censored and filtered than other services, is going to make a positive difference. I mean, in terms of raising the odds of success.
Let's talk about your big five, and you can tell the audience our big five's a little different. We don't include genomics, but we're not in that business. But anyway, how do you see what are you most excited about with your big five, and where do you see Florida particularly being able to play in these disruptive technologies that are all hitting us at the same time?
Right. So the 5 big platforms, innovation platforms, we call them: robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing. That last one you're not involved in. But that one might be the biggest surprise, and it certainly will have some of the most profound ramifications, because AI is really the glue that's causing all kinds of convergences to take place, and especially in the multi-omics space, we are finally able, now that we can sequence genomes, transcriptomes, proteomes, we can identify mutations in them. Mutations are simply programming errors in our bodies, and we get more programming errors as we age. Now that we can identify them, there are about 6 billion bits of code in our genomes, just our genomes. Now that we can identify those mutations, we can use other technologies like CRISPR gene editing to reprogram the genome. So, you know, we've now got the first functional cures for beta thalassemia and sickle cell disease. These could not be cured. You know, the first man in the first trial, CRISPR Therapeutics trial for beta thalassemia, had to go to the hospital on an emergency basis 17 times per year on average, and he's an adult now. He got one edit to his genome and has not been to the hospital on an emergency basis for the past 3 years. So, I mean, so we're talking about curing disease, and CRISPR Therapeutics, one of its biggest projects, is diabetes, both type 1 and type 2. And anyone with a child with type 1 diabetes knows what a cure would mean to the entire family's life. So,
oh my gosh,
yeah.
That's a game changer.
So which one are we most excited about? I think in terms of the one most underestimated is that one. It's complicated. It's just really complicated. You need deep domain expertise, and it involves regulation, which tech investors don't like, and it involves reimbursement, which tech investors don't like. But I think it holds the promise of some of the most significant companies you've never heard of, right?
Yeah.
In terms of this idea of convergence, the biggest convergence taking place out there is what we just talked about. Because, and Tesla is the poster child for this, it's not an auto company, it's a robot company. It has 5 million out there, I mentioned. It's an energy storage company. All of these are going to be electric. Total cost of ownership and continuing cost of loans will ensure that. And it will be powered by AI. So the way I like to talk about it is, talk about, I just did a podcast yesterday with Peter Diamandis, which is some of you may know, and he described this as, you know, S-curves feeding one another, and I used to say feeding one another, creating super exponential growth opportunities. He put it in a better way, a tsunami of growth. You've got these S-curves. And Tesla does, I mean, it's epitomizes what we're talking about here. And we will put out in a couple of weeks a convergence paper describing this. But when you've got robotics and energy storage and AI intersecting, converging with one another, there's going to be explosive growth opportunities. And I think that the way most research teams are set up out there in our business, they're not set up because there's too much sector work and therefore turf warfare when all of these technologies are converging and blurring the lines between and among sectors.
Yeah, interesting. So when you look at Florida and these technologies, are we well positioned? And
you know, any place that is a good place to do business, and Florida is, with some of the infrastructure problems that we think innovation will solve, I think Florida is going to be a mecca for innovation.
You hear that? How exciting is that? We believe that, that's for sure.
Absolutely, absolutely. We want to be a part of making that happen too, as do you.
Yeah. One of your other big five is blockchain.
Mm-hmm.
I'm curious how you look at blockchain versus crypto, and you know where you see that going over the in the future.
Yeah.
You know, it was way up, then it crashed, and you know.
So we think blockchain technology is really 3 revolutions in one. The first and the biggest, and we believe it will remain the biggest, is Bitcoin, because it itself is 3 things in one. It is a new global monetary system. That's a big idea. You know, first, global, private, no government oversight, decentralized, rules-based. That's probably the most important of those monetary system in history, digital in history. And so, very big idea. It is a new asset class, and as you may know, we were among the 11 ETFs approved
Very exciting.
on the spot Bitcoin ETFs approved on on day one, and we're already up. We're not even. Are we a month into this? Yes, we're a month into this, I suppose. But yeah, 6 weeks into it,
How much money has flowed into your fund?
almost 1.8 billion,
Wow.
which is, and this is the global financial superhighway. It's a public good. We've priced it that way. We don't expect to make a lot of money on it. We just want everyone to have access to it because we think it's that important. And yes, it is. Will it serve? It's a store of value, so it's digital gold right now. Will it serve the other two roles of money?
Will it ever be transactional? Do you see?
Yes, the Lightning Network work already in emerging markets is transforming some of the emerging markets and redefining division of labor. We think we understand gig economy here. Put that on steroids and go to Africa and see how the the micro division of labor that's taking place. You can learn more about this on something. It's our Bitcoin brainstorm. We do this once a month. That was our second episode. And I have to tell you, I have the privilege of being on all of these. I'm the Dell portfolio manager. They're the technologists, and I'm just blown away by what's going on out there. So that's the first revolution. And it's really the monetary revolution. Then there is what we're calling, what many people call DeFi. We're renaming it. That sounds quite defiant, right? So we're calling it the Internet Financial System. Because what is it? This is just very basic. All this is the layer of the Internet that developers did not create in the 90s. Why? They didn't think commerce or financial services would take place on the Internet. It was simply to exchange information, not value of anything, right? And in fact, we were coming from a place where, from a consumer's point of view, it was illegal to use the Internet in the 80s. We needed a Telecommunications Act to change that. So we were coming...
We have Al Gore to thank for that.
Pardon?
We have Al Gore to thank for that.
Oh, of course. Yeah, of course. We were coming from such a strange place. What is this? Katie Couric, what is this? Nobody thought this was going to become the financial engine that it is. This is putting that layer in now. It should have been.
It's so archaic. I mean, half these banks are running codes that were written in the 90s.
Yeah, we're going to.
They still hold checks. I deposited a check not that long ago. They were holding it for 7 days.
Oh, I know, it's ridiculous. Yeah, I know. So here, we've done our digital wallet work. Early on as we were doing work on Cash App, which is very focused on Bitcoin as well, we illustrated that, there are 7 steps between a consumer and a merchant in terms of a transaction, 7 steps, 7 middlemen, and that's, those are kind of the direct steps. So you go back into the ecosystem, there are even more middlemen, right? Peer-to-peer is going to eliminate that tax. It's a tax. It's somewhere between a 1.5% and 4% tax, and even much more in.
And when do you see that happen?
You know what? Slowly and then all at once.
Which is usually the way it goes.
Which is right. It's going to take a long time. Many people would say, "Oh, good enough," until we're getting a lot of creativity and innovation in the blockchain space. A lot of it was chased away from America by the SEC, so that's unfortunate. But it's interesting. It's starting to come back, I feel, which is interesting. We see the number of new projects. I think I saw this the other day. 66% of them are starting in the U.S. now. I thought we had chased much more of that away. We probably would have had 95% were it not for the SEC. So there's an explosion of innovation taking place, and you've got AI converging with it in a way that, again, the creativity here and the kinds of financial activities that are going to take place, and how we're going to change. I mean, our business is going to be disrupted. Certainly in the public world, portfolio managers will become power users of this ecosystem, as we stake and become just much more involved personally in what's going on. So I'm kind of excited.
Yeah, speaking of AI, I got to ask you about that. So what's the saying going around that you're not going to be replaced by AI. Your job's not going to be replaced by AI. Your job's going to be replaced by a human using AI. How do you look at AI in terms of employment and the effect it's going to have, you know, over the next 5 years?
Very short term, I think companies, this has to do with our macro outlook too. I think companies are losing pricing power. That they're not only is inflation coming down. I mean, Domino's reported 1% inflation yesterday in its report, and Walmart is saying deflation, maybe not as much as it once thought. But I think you're going to hear the word deflation a lot more. And as companies adjust to that, you know, they're honestly they're hostage to short-term oriented shareholders who think about margins and profits and dividends and share repurchases. So they're going to try and salvage their margins by using this massive productivity enhancing tool. And in the tech sector, it's already responsible for a lot of layoffs. So we think that in the short term, it will be connected to layoffs. The history of technology is, it is a net job creator, no doubt about it.
But this time?
Yes, and we won't even have, we have no idea what some of those jobs are going to be. We did not know 2 years ago that something called a prompt engineer would happen upon the scene. But AI, we all can become programmers now, natural language programming. We know that. We'll all become programmers. It's just we have to learn how to prompt engineer a little better.
Oh, so I'm going to be able to get Mark Blumenthal to write that. That sounds a little scary. I want to ask you about, you know, when you take AI and you look at AI, first of all, do you think AI is a bubble? I got to ask you that right now. With NVIDIA being the third most valuable company on the planet.
We don't think this is a bubble. This is nothing. I was in the late 90s. I was there. Many people in the business were not there. This is nothing like that. This is the seeds that were planted in the 20 years that ended in the tech and telecom bubble have been germinating, and now they're blossoming. And one of those is AI, deep learning, transformer architecture, and so forth. Here we are. And artificial general intelligence. If you look at ChatGPT, well, before ChatGPT, 2019, there's a survey of futurists out there that we monitor, and one of the regular questions over time has been, when do you think AGI will hit? And back in 2019, the answer was in 80 years. Today, the answer is 8 years. And Elon would say 3 years. But, you know,
Even though to exaggerate.
You know what? But what he is doing is he's getting his employees, his suppliers, he's getting everyone motivated to move into action, to make something that he believes will happen. And it does take a while to get supply chains organized and all of that. So, yeah.
Yeah, I got to ask you this, speaking of that. So, when I look at AI, if you look at the history of technology, it's always been the startups that have really brought us disruptive technology. I mean, you can go back to Google, you can go back to Apple, you can go back to, it was never the incumbents, IBM, or should have owned the PC space, but they did. And then, there's multiple examples of this. The legacy companies don't make the next shift. So it's really two questions. On the legacy side, do you think General Motors and Ford, BMW and Mercedes are dead? Do you think the EVs will all take over? And then the second question is really, startups have always done this, but now with AI, Microsoft's a big player, Google's a big player. Are the startups going to be able to compete in AI?
Yeah. Well, clearly, Microsoft is doing an amazing job. Satya has, I've never seen anything like this. We just went through this morning a list. If you look at the decades, during the decades, there's only one company that has been able to be in the top 10 most highly valued stocks in the world, 3 decades in a row, and that's Microsoft. So hats off to him. We don't own it. You know, we don't own it. It's not what we do. We don't own the Magnificent Six. We do own Tesla. In the flagship, we don't own NVIDIA. Why is it we don't? It's not that, it has dropped below our hurdle rate of return. We are pushing, we're probably the most aggressive in terms of our AI expectations out there. And even with those very aggressive expectations, and assuming that NVIDIA gets part, not just of the hardware market, but part of the software market as well. Don't know if they will. They're getting a bit of it now. Our minimum hurdle rate of return for any stock in the portfolio is 15% at a compound annual rate for 5 years. NVIDIA does not meet that. Now, if we push it extra hard, we can get it to, but we have so many other stocks who meet the 4 characteristics that we think will define success in the AI age. It is deep domain expertise. Multi-omics being a great example there. Deep domain expertise. AI expertise, taking this serious. Global distribution, either through partnerships or alone. And then most important is that data as we start. The proprietary data that no one has and no one can get, right? That is the lens that we've built our portfolio through. You know, I was saying to my team today, and we have with us here our President and COO, our CFO, Chief Strategy Officer, and our CMO. So, you know, I said, wow, this is a big deal. Normally, we never hop in the car together, right? So,
thanks for bringing the team.
Yeah. But
they're the A team, right?
Oh yeah, absolutely. You'll never find any like them out there. But I was saying to them, you know, you'd think we don't manage equities. Yesterday the market was down, and we were up 3.5% or 3.2%, our flagship. Today the market is flat to down, and we're up 2.5%. What's fascinating out there is the traditional asset management world has put us in what they call a new asset class. I find that interesting.
What class is that?
I don't know, you know, to be honest, and this is why I started ARC. This is why I started ARC, and the fact that I'm saying this to you means we've met some success here. I started ARC because I saw the traditional financial world going more benchmark sensitive and passive. I saw the traditional world investing in the past. So I'm going to come back to your questions about who wins here. I think there are going to be so many winners in AI. And that, believe it or not, Google probably might be one of the biggest losers out there. Because this strikes at its heart, advertising. If I can ask GPT-4 a question and get the answer right away, and not have to go through any links. Oh yeah. My gosh, now I know Google's trying to get into that game now. But, you know, I think the boom is off the rose. I think they have a problem. I think they have a big problem.
So they're the legacy company that won't make this.
Possibly. And most people are shocked because they bought DeepMind, which has probably the most brilliant AI experts in the world. Then they put out Gemini, that model, and everybody's seeing how biased it is. It's just like, oh man, you know, they're so scared of insulting anyone or being sued, or I don't know what has gotten into them, but it's a big problem for them.
So that ask question search side, the Google's at risk, do you see that it really Bing? Or what's Microsoft's new product? Their search product? Or do you see ChatGPT?
Yeah, ChatGPT, I mean, there are going to be many flavors of this, right? And that's another consideration too, right? Google have this market to itself pretty much, right? And you can even with Amazon. Now, we all use Amazon. Amazon's not going away. I happen to think it's becoming a very mature company. And one of the reasons is it's not a social network, and a lot of young people shop on their social networks. So that's one issue. Another issue is if I can order the cheapest pair of, I don't know what's, I'm not hip or anything, but the cheapest whatever popular item out there for no shipping, and I can just say, okay, GPT-4, would you go find that for me? I'm happy not to go to Amazon if it gives me everything I want, and if it bypasses Amazon.
I call that feeless and frictionless.
Yes, yes.
That's what I want when I buy stuff.
Yes, I mean, I think the most remarkable company, Microsoft's doing a great job. It has a legacy ecosystem, and I think there are a lot of companies coming for it, especially in the small and medium business side of the business. But Meta platforms, it is going the open source route with AI, which I would like to think that open source will win. We had a Spaces with Elon a few weeks ago, and he thinks closed is going to win. But I'd like to think that our chart, and it's in our Big Ideas 2024, which we put out in January, if you look at all of the closed or private large language models, and you compare them against the open, GPT-4 is far and away the best. Llama 2, when it came out, vis-a-vis GPT-3, was good enough, right? And I'm very excited to see Llama 3. If you look at the slopes of the two lines, the closed line is a shallower slope than open source. The performance of the large language models, open source large language models, is improving faster than the closed source. And so if that continues, and I think open source could win, because Meta platform is leading the charge, and by all the GPUs and pouring, why are they doing this and then just giving it away? Because those large language models are more enterprise facing, and it is more consumer facing. It takes everything that developers have developed in this open source ecosystem and builds on top of it for its own ecosystem and its own business. So I think open source can win. But I'm watching this. It's a fascinating story. I was a little sad when Elon doesn't trust his judgment so much. A little sad, and he hates OpenAI so much.
And he hates Zuckerberg.
And he hates Zuck. Yeah. So I was a little disappointed. Well, maybe that's why.
When's that wrestling match or whatever?
I don't know. Come to think of it, we kind of forgot about that. Yeah.
My money was on Zuck. I don't know. Elon looks a little out of shape to me.
Don't put anything past.
I know, you can't underestimate
Yeah.
So, I wanted to ask you a little bit, the ARC Innovation Center in downtown St. Pete.
Can I make one more point about AI that I think is not well recognized out there, but is going to be very important for companies? And if you look at, there's a Bain consulting study. They studied two sets of consultants, high-performing consultants and lower performing consultants in Bain. And then they gave them each, I think it was ChatGPT. And what they found is the performance level of the high performers increased 17%. The performance level of the low performers increased 43%. So that is something to consider when back to your question about the mega companies, are they going to run away with this? I think the playing field is being leveled here in an important way, and certainly in that way and other ways that I just described. So that's one reason we don't own them. We don't have to own them. Everybody owns them. If you own the S&P 500 or the NASDAQ, you own them in spades. You don't need us to own them.
Okay, so I wanted to ask you a little bit about ARC Innovation Center in downtown. How many people have been to the ARC Innovation Center? Know what it is? So, why don't you tell them?
Sure.
Tell us your vision for this.
Sure. So we are in partnership with St. Petersburg on the Innovation Center. It has been in development for 10 years. We just happened upon the scene and give them all credit for putting that building up. And then now the hard part starts. So it's going to be very interesting to see what happens. And so we gave it naming rights. I really didn't want our name on it, you know, was it the
Our name's on it too, by the way, but it's a lot smaller.
Oh, okay, yes.
we wrote a lot smaller check. We wrote a check.
Yes, well, I can tell you when they approached us. They approached us when we couldn't do anything wrong. And when I was telling to our team, I said, okay, watch out. Whenever an investor feels like he or she or the firm can do nothing wrong, then you know what's about to hit the fan. So I was saying that, and yet we felt, we went up 360% in performance in 9 months, right? As COVID played out, and the rest is history. And we knew that we would be riding for a fall. We didn't believe for 1 second that our decline would be worse than NASDAQ in the early 2000s. And it was shocking, because the difference between then, too much capital, chasing too few opportunities, too soon, ended badly, and now people being afraid of investing in innovation, and yet the technology is being ready for prime time. Think about that from a human psychology point of view. Ready for prime time, ready to go, and people running away. Anyway, so back to the Innovation Center. So we did write a big check for that. A much bigger check than we would have written today. Just wanted to set that up. And got the naming rights. And you know, we're the newbies in town. What our agreement is, they are going to use our research as the screen for the companies they select for the incubation, to incubate there. And we're also locating ARC Educate, which is it's ARC Education Initiative is the long name, but ARC Educate. We're going to train teachers there. We're going to have, we're going to showcase innovation there. And, you know, we hope it becomes, we hope it attracts startups. Now, the other infrastructure problem in St. Pete and everywhere around here is housing. And so, you know, we're working with the city and other potential partners on that. So, but we're the screen for the companies they choose. We, of course, will be there to, when they do the pitch days, we'll give keynotes and things like that. And over time, we'll probably work more closely together. We do intend to start an early stage venture company. We'd love to work with you, alongside you, partnering on early stage venture here in Florida. We think we'll probably be maybe broader based in terms of hoping to attract people to the incubation center, working in collaboration with Embark Collective. I think Lakshmi has done an amazing job.
Yes, she does.
Yes. So we're at the early stages of what it's going to become. Very hopeful. We know the hard work is just beginning, and I think they're still, as I mentioned to you, Tom, at the beginning, they're still waiting for the certificate of occupancy. So that's the gating factor here.
That's very exciting, and if you haven't been to the ARC Innovation Center, once we get to occupancy, you got to check it out. It's going to be great for downtown St. Pete. It's south of downtown St. Pete.
Yes.
Okay, so how are we on time, Saxon? Oh, I can't see it. It's below my thing. Right. Okay. So, have you ever heard of the lightning round?
Yes.
Okay, so this is a lightning round. I'm going to ask you a few questions.
Oh, I'm really bad at this.
And you answer quickly and shortly.
Usually, where's Lisa? Where's Lisa? Usually Lisa coaches me. She didn't coach me on this. I'm terrible at this. I am.
All right, first question.
I'm sure it's cultural and I don't know the bands or anything
All right, first question in the lightning round. When will Bitcoin hit $100,000?
I think it could this year.
This year? Wow. Okay. Who wins the AI search race? ChatGPT, Microsoft, Google, or some startup?
I think open source.
Open source. Yeah.
In terms of what we're talking about, large language models, the number of beneficiaries from AI, which is going to be the biggest productivity enhancer in history, that is going to be widespread.
What is greater, the opportunity that AI presents to all of us, including mankind, or the possibility of it hurting us?
And the opportunity is much greater, I think, than the risk. One of the things we are happy to hear is that so many people are worried, including Elon Musk. I think it's really important to state the problem.
Elon's been very good.
Yes, to state the problem, because half of the solution to the problem is in the works. Startups are on the way. This is why we want an open source model to win, or sets of models to win, because that's like a giant neighborhood watch, right? That's been the history of open source. Linux has been fantastic. And blockchain technology, crypto. If you look at Bitcoin, the underlying, the base layer, not been hacked. Giant neighborhood watch. There are a lot of white hats out there that are on the lookout for anyone who's going to jeopardize, their livelihood by harming the ecosystem.
Okay. What year will we land somebody on Mars?
It's really up to Elon, isn't it?
Definitely his mission.
I think, what did he say? I don't know, on our spaces, I think he was, now this is Elon time, right? So, right, I think he said he'd like to think he could do it in 10 years. Am I right on that, Lisa? Or did I say, did anybody tune in? I think it was, something like that.
Go ahead, Lisa.
You think I'm right?
Okay. If you could only own one publicly traded stock today, what would it be?
Tesla.
Is Jeff Bezos moving to Miami going to have much of an impact on Florida and Miami? Is that a game changer?
I don't think it's a game changer. It's more of the same. It is interesting you chose Florida.
Wait, from Miami?
Oh, see, I didn't know that.
He went to high school.
Okay.
He went to high school with Mark Blumenthal's wife.
Okay. All right. So that also explains. That brings me to another point. What's interesting today in terms of art is many people told us not to move to Florida because we wouldn't be able to get the talent and blah, blah, blah. What we're finding is people who went to school in Florida and couldn't find the job they wanted and had to go to New York or Chicago or San Francisco.
They're coming back, right?
They are self-selecting. We are getting incomings. So that I didn't expect to happen this soon.
Yeah, it's very exciting. One of the things we've always said is one of our missions in Florida Funders is to attract the best and brightest entrepreneurs to Florida to start their companies.
Yes.
Where just a decade ago they were leaving to raise money. So
Yes.
that's something
Yes.
that's really welcoming.
Yes.
We have amazing talent.
Yes. Yes.
That's all I've got.
Well, just on that, in terms of...
Did I forget to ask you anything?
No, I'm just on the university system around here. I did not know, we had already made the decision, I did not know that USF is an R1 school, Research 1 school. I think, how many are there? 66? Tom, I think knows the answer to that. It's something like that, there are only 66, USF is 1, and it houses the Institute of Inventors. I didn't know that either. And so really, and now it's AAU, and here we go. And I didn't go there, I'm not cheering the school, I'm very happy it's here, that's all I'm saying.
Is there anything I didn't ask you you'd like to share with the audience?
Yes, okay. To summarize what we've just said in terms of the opportunity, you'll find this in our big ideas, you'll see the building blocks in there. So this convergence of among technologies. If you look at disruptive innovation, somewhat broadly defined, more broadly than I would define it, but somewhat broadly defined, it is valued in the global public and private equity markets today at roughly 19 trillion. So about 10%, maybe a little more, of the global equity market cap. If we are right, that 20-ish billion will scale to 220 trillion. Did I say trillion? I meant trillion. Trillion by 2030. That's a 40% compound annual rate of return. And that's what we believe is going to happen. Right now, that 10% I mentioned, we think that's going to explode in terms of the benchmarks out there and become 60% of the benchmark. So if you look at our portfolios today, what we're really saying is these are the benchmark stocks of the future. And then maybe we'll be on to the next new thing. But that's how explosive we think this convergence is going to be. This has never happened in history. The closest to what we're going through now was in the late 1800s, early 1900s, telephone, electricity, internal combustion engine. And that transformed the world. We all moved off the farms. This is going to be, this is 5 platforms converging. They involve 14 different technologies. That's how our analyst responsibilities are set up by those 14. They are all converging. And one of the questions you were going to ask is, that I did see was, why is Elon Musk the inventor of our generation? Why is it Elon?
Yeah, I didn't get that. I'm glad you brought that up.
Yes, and I think it is. He's all about first principles research. Just because something's been done some way for 100 years doesn't mean that's the right way. And probably, if it's regulated, it's probably all wrong, right? So first principles thinking, and this idea of convergence. He is thinking in terms of the convergence among technologies. And so people say, well, how could he, be so good at this, SpaceX and Tesla, and let's see what happens with
6 companies now.
Yeah, well, let's see what happens with X and Neuralink and Boring. And I think he understands this convergence, and he saw it coming a